Good morning, everyone. It's Thursday, January 19th here in New York City. This is Yahoo Finance Live. I'm Brad Smith. Alongside Jared Blickery in studio, Brian Sazi and Julie Hyman are standing by in Davos. You see them there on screen. We're going to get to them in just a bit. But right now, let's get to the top three things that you need to know as the clock hits 9 a.m. Wreckage in tech. The industry hitting the highest number of job cuts since the dot-com bubble more than 20 years ago. So is the period of growth officially over here?
I think when we see a lot of peer companies laying people off, when we see people in the tech industry really struggling, the idea of throwing in flying in a big performer, spending a ton of money on a lavish party didn't make a bunch of sense.
We'll go live to Davos, Switzerland, and hear more from top executives on what could come next for the battered sector.
Plus, a mixed quarter for Procter & Gamble with shrinking consumer demand offsetting higher prices. We're going to bring you the details.
And more trouble for crypto. Crypto lender Genesis could reportedly file for bankruptcy as early as today. We're going to tell you what that means for the broader industry. But we begin today with troubled tech. The job cuts in the tech industry continue to pile up in 2023 after the industry had over 150,000 layoffs in 2022. Yahoo Finance's Brian Sazi and Julie Hyman have been boots on the ground all week in Davos, and I will say parkas on as well. They've been in Switzerland at the World Economic Forum hearing from prominent CEOs. Guys, give us the scoop on what they're saying.
Yeah, Brad, it has been layoff central here, and while the World Economic Forum has kicked off, we got news of those 10,000 strong Microsoft layoffs here, in addition to everything we heard from Salesforce and many other tech companies. And Julie, we've been putting this to every single tech executive that has come on Yahoo Finance at the World Economic Forum. Are you laying people off? Some aren't. You look at HPE CEO Antonio Neri, he says, we're not laying people off because we thought about this stuff happening 2 years ago. But again, that's the exception, not the norm.
Yeah, it doesn't feel like it is a wholesale across the board. We're going to see a lot of cuts in the industry necessarily at every company, and even within companies, it's not going to be in every part of the company. So here's a sampling of what we heard from those executives.
Anything that has people implications are probably the hardest decisions we have to make as executives, but at the same time, they are the right thing to do for the success of the company.
I think it's pretty difficult to say. I think the next couple of quarters are really going to tell us what's really going to happen in the economy.
We will continue to reallocate resources. In fact, we continue to hire in some areas where we need the talent.
So while we are not in a position to have to do layoffs, we certainly have, slowed down hiring a bit during the back half of the year.
I think when we see a lot of peer companies laying people off, when we see people in the tech industry really struggling, the idea of throwing in flying in a big performer, spending a ton of money on a lavish party didn't make a bunch of sense.
That last one, by the way, was Matthew Prince, the Cloudflare CEO, and he was speaking not too subtly about some of his competitors here. Microsoft held a big party. They invited Sting to play. And then there is a Salesforce party this evening with an as-yet-to-be-announced guest. It'll be a surprise musical guest at that one. So that costs a pretty penny.
Yes, indeed does. At the time they're trying to cut lots of pennies by laying off these workers. But I was just moderating a panel for the World Economic Forum. Qualcomm was on there. HPE's COO was on there as well. We're seeing news of lots of layoffs, yes, but there is this next generation of technology forum. We've been talking about it all week, notably in artificial intelligence. There's still a lot of hiring going on in tech. It just may not be in the areas that we're being hired for during the pandemic.
Exactly. That's exactly what we were hearing from people, Brad and Jared.
Guys, we got to talk about Elon Musk because he has been heading over to Twitter, which he owns now, asking about Davos, tweeting a poll. The World Economic Forum should control the world, yes or no? Majority of respondents said no. And Julie, I know you've been tweeting about this or something related yourself.
I mean, what are they going to say? It's the dumbest poll ever. I think Elon's just upset he's not here and he wants the attention back on him rather than on the goings on here. I mean, yes, there is concern, right, that you have executives, world leaders here sort of setting agendas. I don't know, Saz, what's your feeling on this whole
I'm going to decode
narrative?
This poll from Elon in real time, Julian, and it's something like this. Put a tweet out there. Critiquing the most important conference kickoff 2023, and maybe you'll get more promotion out there on Twitter and Facebook and other platforms, and you might sell more Teslas because you just probably missed your fourth quarter and because the company's still under a lot of pressure. That is what I'm thinking. And
Interesting.
Then secondarily, let's keep in mind, Elon has not even been invited to this event since 2015. The World Economic Forum came out early in the week amidst that just criticism from Musk on Twitter. He said, Elon hasn't even got an invite. So you can't come to this if you don't even have an invite. So I don't know what Elon is thinking about here. Let him go sell some Teslas. Let him go play around on Twitter. Maybe he'll be here 10 years from now.
I mean, I will say, you know, of course, there are a lot of critics around the globe who talk about the World Economic Forum that being out of touch. They haven't been aggressive enough on climate change. Certainly, Greta Thunberg has been someone who has talked about that, and she's here once again making that point, which is a valid one. At the same time, I think it also misses the point of why so many executives and world leaders continue to come here. We talked to the Chainalysis CEO, Michael Groniger, a little bit earlier. He said this is 3 months of travel in 4 days. It is just a very distilled, efficient way to meet with a lot of people in a very short amount of time.
I'll add this too. We've interviewed close to, I'll upsell, let's say 40 executives. We have a lot of conversations. We've been out pounding the pavement all week. Elon Musk, at least for me, has not come up one single time. So the man who tries to make himself the most relevant person in the world, these people here could really care less. They're focused on growing their business, getting new business into their business, and thinking about the next decade for their own businesses. Elon Musk, for them, Elon Musk who?
And so within those conversations, I want to piggyback off of what you just said at the end there, Sazi, and trying to get new business while they're out there. Does this signal to you that in some of the posturing and in some of the commentary that you're hearing from whether it's ServiceNow CEO or whether it's some of the HP CEOs of the world, that they're trying to signal to their prospective clients that, hey, with our business, everything is fine. Yeah, there might be a shallow or a mild recession to come, but for our business, we believe that we can operate through this so that their clients, prospective clients, then feel confident.
Right, Brad. They're focused on not only setting up business for this quarter or the next quarter, but it is for the next decade, and also to get a lot of ideas on how they should ultimately position their business. And I go back to what Elon, his just critique of this event this week. Nobody's talking about him. Nobody cares. And a lot of these executives aren't even on Twitter. And if they are, guys, they have social media accounts and other people running these Twitter accounts. Elon Musk what I'm trying to say is just does not dominate their lives.
Yeah, no. So to come back to your point there, Brad, yes, certainly that is something that is a factor here, that they want to project strength in a time of economic weakness. I also want to make the point that sort of the takeaway on the economic front for us has been that people are cautiously optimistic, or at least not too pessimistic about what's going to happen with the economy and specifically what's going to happen with their businesses. However, the consensus coming out of Davos is frequently wrong. So that's something to point out, right? That in terms of trying to call where the economy is going and listening to the consensus, the conventional wisdom here, that's not always guided you in the right direction.
No, Julie, that's so on the mark. I was here in May for the faux World Economic Forum during summertime, and we broadcast all week. And I left thinking, wow, GDP is going to grow at 10%. We're in a boom, and that has not happened. Stocks came under pressure, and recession talk absolutely dominated the scene. So I'm leaving this event thinking maybe things will be better than many people expect. But again, who knows?
Who knows? And you guys try to get warm a little bit. We're going to be coming to you throughout the day here, and we got to switch gears to some earnings news. Procter & Gamble out with its latest report, posting a slight miss on profits. You can see the stock down there about 1.5%. Declining sales volume, higher prices of its product. This is weighing on consumers. Sales volume saw its biggest quarterly drop in years, while prices increased by 10% during the quarter. And Brad, the price increase, I think, of 10% that consumers were able to withstand that, and that they're still seeing some organic revenue growth here is a positive, but their projection for the full year forecast, they're still seeing EPS growth at the low end of 0 to 4%. There were some analysts who thought they might withdraw the low end of that range, so could be 0%. And then organic revenue, they're seeing for the full year 4 to 5%. They previously saw 3 to 5%, so they're raising the low end of that, but meanwhile, the estimate was 5.21%. So the street a little bit disappointed by this.
Yeah, you're taking a look at some of the segment organic sales growth on the screen there. Healthcare remaining strong, fabric, home care remaining strong, beauty was up 3%. And you're talking about some of both the necessities there, plus some of the little luxuries that people will continue to buy into, or at least see some type of value exchange in terms of still spending some of those discretionary dollars, but in things that are a mix of necessity, but also something that just helps them feel a little bit better, even though perhaps they might be pinching pennies in other categories of their expenditures within the home as well.
You know, Brad, where they might be pinching pennies here, I'm seeing organic revenue, which was for the firm or for the company up 5%. For grooming, organic sales were 0%. So maybe people just gave up grooming. over the quarter? I don't know.
Look, I mean, I've tried to lean into it a little bit more, but we have a different type of position that we're in where we have to account for that. But within some of the organic sales, and even what the company is saying, organic sales increasing 3% versus a year ago for skin and personal care organic sales. They increased low single digits. I think going forward from here, it's going to be important to keep track on some of those little luxury categories, but then in addition, to see what types of strategic pricing mechanisms P&G implements or continues to be cautious of, knowing where the consumer may be pushing back on some of that pricing. We've seen that show up in earnings or even in business updates for some of the more discretionary products, largely apparel and footwear. So when does that start to trickle even into some of the little luxuries, from the cup of coffee all the way into the type of fabric softener that you might be buying at the end of the day too?
Yeah, I have to agree with you there. The price pressures from this year probably not going to be in the good from the goods sector, going to be more on the wages. So P&G may be getting a little bit of a pass from that this year, but we don't know how it's going to unfold.
Well, we got another big story that we're tracking here today as well. Crypto firm Genesis preparing to file for bankruptcy. This move comes 2 weeks after Genesis laid off about 30% of its staff as the crypto industry struggles to bounce back after the fallout from FTX. We've got Yahoo Finance's David Hollerith on the case and with the details. David, what do we know?
Brad, the bankruptcy has not happened yet. Institutional crypto lending outfit Genesis Global Capital, and it's has, at least on paper, been struggling for months to come to some resolution in this situation. Over the past 2 months, they've sought funding unsuccessfully and have indicated bankruptcy could be a possibility. Creditors have also organized into 3 major groups, and now we're seeing what could be a pre-agreement bankruptcy transaction, which would be a cleaner process than previous crypto filings. So the players are Genesis, its creditors, and Digital Currency Group, the parent company of Genesis. Over the past week, negotiations between those parties have been nonstop. Both sides are now in the process of drafting what looks like a term sheet or document that would indicate how the agreement would work prior to the filing of bankruptcy. A document shared with us yesterday indicated that this is fast approaching and could happen any day now. That being said, in an ideal world, a majority creditor vote would have to approve this term sheet, and that's the final step before Genesis would file bankruptcy. Yeah, however, I do want to stress the deal isn't done yet. Gemini's earned customers are the largest creditor group, and they have the most voting power.
All right. Well, we're going to see how that unfolds. At least it's not the big one, Binance, just yet. Got to talk to you about CoinDesk, because we saw this morning that they have tapped bankers for a potential sale, which I think is interesting because they are affiliates of Grayscale Investments, which manages the Grayscale Bitcoin Trust and Ethereum Trust, and basically the biggest ETF provider of crypto products, I believe, in the world.
Right, Jared. So that's the issue. Digital Currency Group is the parent company of all these firms: Grayscale Investment Trust, CoinDesk, also Bitcoin mining firm Foundry. They own a lot of crypto companies. They're sort of an empire. So at this point, Digital Currency Group owes Genesis at least $600 million in loans. And that number is highly subjective depending on the terms of a note that they gave to Genesis over the summer. So what we're going to be looking to see is what the agreement between DCG and Genesis creditors is going to look like. It's been floated, at least, or proposed by DCG, that DCG may ask for some kind of forbearance period in which they don't pay back creditors the full amount they owe Genesis within a 2-year period, as much as a 2-year period, excuse me. And it could also include payments of DCG equity and cash. Now, that being said, creditors here want to get their money back as soon as possible, but they also want to get as much money back. And that means that they may be willing to wait for DCG to be able to pay back its loans. Now, this all means, why hasn't DCG already stepped in? There are questions, obviously, about whether or not they have enough money. If they don't, they can sell some of their assets. They have sizable holdings of the Grayscale Bitcoin Trust. They also have this large portfolio of companies. So we're going to be waiting to see what will happen there, and there could be any combination of that. Obviously, DCG doesn't want to sell its portfolio companies, but at this point, it's going to have to make a decision about what's best to save its empire.
I like that. DCG, the empire, or sort of empire. We're going to have to see how all this plays out, potentially in the courts. Thank you for that, David Hollerith. Coming up, recession is on the top of mind for investors. We're going to break down some of the key views to keep an eye on this year.
Mild recession, slightly down for a couple of quarters and then back to slightly up and then more normal in 24 and into 25.
I don't think that we are too deep into recession so far.
There will be parts of the world that go into recession this year, but we will choose to ignore that in the parts of the world that are enjoying continued growth.
The numbers that we have in our own companies at Carlyle don't suggest a recession is imminent. And we also think that the U.S. policy to get inflation down is probably working. And so I don't really think it's clear we're going to go into recession in the third or fourth quarter.
Recession is top of mind at the World Economic Forum as we continue to hear from execs across the board on recession expectations for the year ahead. And for more on this, along with key views to keep in mind for 2023, we have Craig Fair, Edward Jones Principal Investment Strategist. Thank you for joining us here today. Let's start with the big R. It seems as though a recession is priced in, but maybe a Goldilocks soft landing-ish type recession, because you take a look at credit spreads, those are pretty low, not the typical dire warning that you would get before a big recession. Your thoughts?
Yeah, I think you're right. The big R is exactly what the markets are now going to start focusing on. We spent all of 2022 focused on the big I of inflation. It's not as if inflation is now a problem solved. However, I think markets are now going to start to fixate and focus and respond to the path ahead for the economy. And you're exactly right. We are not seeing a consensus level across every metric, forward and coincident, that would tell us recession is inevitable. Our forward-looking economic model has been telling us now for several months that a recession is probable. That's our base case, that we do find ourselves in some form of a mild recession. I think we heard that from a few of the clips that you just posted. It's not because we're being Pollyannish. It's because we think that there are some structural components of the economy that will allow us to have a more shallow downturn as opposed to something more severe. But without question, if you look at the stock and the bond market, depending on the day, you're going to get different signals about what is embedded or priced into this market. And I think yesterday was a very interesting example. We saw yields drop sharply. That would be reflective of a bond market that is acknowledging that an economic downturn is coming. We've seen equity markets that haven't been so convinced, partly because equities are responding both to the Fed letting its foot off the brake a little bit, potentially later this year, but also the prospects of slower economic growth.
I want to jump on something you just said there, and that was your comments on the bond market. We saw I think it was a 10-year drop, 16 basis points, a 15-year, 17.5 basis points yesterday. Huge moves falling to 4-month lows. And just want to reiterate, what does this say to you? Because in the context of what's happened this year in stocks, we have the Nasdaq outperforming the Dow, which is the inverse of most of last year.
I think yesterday's reaction, and you're spot on to key in on that. I think yesterday's reaction in both the stock and the bond market are exceptionally telling about this transition that we are probably in the early stages of for the financial markets. That transition that we think is one from, as I mentioned before, one from a focus on inflation to now a forward-looking focus on what the outcome of that inflationary environment was, which is what is the path for the economy ahead. So yesterday, interestingly enough, we saw a sharp drop in yields, as you noted, and we also saw a sell-off in equities, which is different than what we saw for almost the entirety of 2022, which was rates up, stocks down, rates down, stocks up. That was the script of the last 12, 13 months. Now we're moving into a new environment, I think, where we're going to start to see equities respond, and bonds for that matter, respond more to what are the prospects for growth ahead. So in other words, putting that more simply, maybe an environment ahead where bad news is bad news and good news is good news, which hasn't always been the case for the last handful of months.
Craig, in some of your views for 2023, you believe that the Fed is going to pause when policy rate nears 5%. Do you believe that 5% threshold is also true terminal, or if that is, just kind of the pause area or the pause ballpark, and then even thereafter they say, okay, we still need to do even more tightening, and what would that terminal rate from your perspective be?
I think 5 is the excellent question, by the way. Markets will probably grapple with this ahead. I think 5 is the both the pause point and the terminal point. How we get there is the next two meetings, the Fed likely hiking by a quarter point in each of those, which recognizing that is a meaningful deceleration from the rate or the path of rate hikes over the last several months. So it is a deceleration there. I think the point that you're making is an important one, because what markets are not braced for is a Fed that perhaps puts in a couple more rate hikes, takes a pause to look around, which, by the way, is I think prudent, and then has to restart the rate hike engine. I think markets would find more comfort. I would certainly find more comfort in a Fed that feels like they've gotten to a level where they can sustainably pause, where they have truly snuffed out the burning embers of inflation, so to speak, to where the next move or the next several moves can be one that are more of moderation. And potentially down the road, as we also expressed in our outlook, we think by the end of 2023, the conversation around rate cuts will start to get a little louder. Not to suggest the Fed has to cut rates in the calendar year, but we think that conversation will pick up a little bit, obviously helped by a decline in inflation. So all that is to say, while we think 5% is a reasonable pause and terminal rate, I think markets would be unsettled if the Fed had to restart that rate hike engine.
Craig Fair, Edward Jones investment strategist. Craig, always a pleasure to get some of your time and insights. We appreciate it this morning.
My pleasure.
Coming up, everyone, we've got the opening bell plus earnings, downgrades, and of course that opening cross, as I mentioned a moment ago. Stick around. Still some time till the opening bell. Let's dive into what's trending here this morning. Let's kick it off with Discover Financial Services. This is the ticker symbol DFS. It's down this morning by about 6.8%. Despite topping earnings expectations, the company saw net income drop 3% year over year, while total net charge-off rates came in higher than anticipated. I think what the street latching onto, though, here this morning, Jared, is some of the provisions for credit losses. And you're kind of keeping a close eye for any of the companies within this card operations or transaction services business around where their delinquency rates are starting to move higher here a little bit. You saw that within the delinquency rate of 30 or more days moving higher, as well as the delinquency rate of 90 or more days, plus the allowance for credit losses, that also budging higher for Discover. So investors perhaps looking into this and saying, okay, clearly if the delinquencies are causing Discover to have to account for more time that consumers are going to take to pay them back, then that's going to be something that hits on Discover's financials, that something that the investors would have to adjust for on their sides as well.
You bet. Delinquencies lead to net charge-offs, NCOs, and that's kind of the name of the game here. I got some notes from the street. Piper Sandler, overweight price target 113, saying that they're noting that the rapid net charge-off growth will likely be an issue across the industry due to outsized growth the last 2 years. And so if that is across the industry, this potential bellwether for more stocks that we're covering here. And this is the time of the quarter when we're getting all these financial players. Also, KBW outperformed price target 135, saying that investors are nervous about credit quality, but the guidance isn't thesis changing. And I got one more here, and this is Citigroup neutral price target 113, saying the company's guidance mixed, but noting that earnings materials lacked details of assumptions, including in guidance, which would appear to us to imply the beginning of a mild recession assumed. So companies getting a little bit murkier about their future. Well, that might be indicating that there is a recession on the horizon. And also by Citigroup here, while likely a positive long-term, investors will likely question growing consumer loans by double digits as we likely enter into a recession. So all getting back to that R word that we've been talking about, Brad. And let me just, we have that stock up on the screen here. This is, the stock has been in a trending sideways. So this is basically a horizontal formation, just kind of treading water here. But you look at the last few years, really interesting to see what's happened since the pandemic. Basically hit this bottom here, rallied, and have hit a top and now have broken out of this trend line. So incremental progress there, but it's hard to get excited based on some of these comments here, especially when you consider the opening bell. That's a segue.
We're taking a look at the NYSE where the opening bell is taking place this morning. All right, there you're taking a look at Tidal ringing the opening bell at the NYSE. And we've got a live look at the virtual employees for Tidal, who are pictured there prominently on your screen and in full view, and then there on the NYSE podium as well. We begin things today with a check of the major averages here, taking a look at the Dow, the S&P 500, and the Nasdaq. The futures were pointing lower, and that's exactly where the opening cross took us. The Dow down by about 0.5%. S&P 500 opens lower by about the same on a percentage basis, and the Nasdaq rounds out the 0.5% decline trifecta there on your screen, down by about 57 points. For more, let's get on over to Jared Blickery at the Yahoo Finance Interactive. Jared.
Yes, more red on the screen throughout the world, by the way, and this is the second day of losses for U.S. stocks, and that was after 7 days of gains in the Nasdaq and 4 in the Dow, so a little bit of a down streak this week. Dow off 0.5%, basically everything there, all the majors, and the Russell 2000 down by 0.5%. Let's look inside the market. Here is the Nasdaq. There we go, a little bit of population there, mostly red and not a big surprise, so let's focus on the green, seeing some movement in China. Pinduoduo, one of the best performers over the last 3 months, period. That is up 2%. Seeing some software names like Adobe, O'Reilly, those are in the green. So let's check off what's going on with software, because we've seen software versus chips. That's kind of the perennial debate, and chips much more cyclical. We've seen them take off over the last, I'd say, basically since the beginning of December, but not seeing a lot of green today. I mentioned Pinduoduo, a Chinese stock before, kind of the Amazon over there, or at least one of them, and we can see a lot of green. China has been moving independently of U.S. stocks, as we know, for at least the last 6, maybe 9 months. And let's just take a look at the sector action, get a macro view on what's happening here. So healthcare almost break even, as is health, utilities and energy. Real estate, the first decliner, that's only 18 basis points to the downside. Financials, the biggest loser here. We'll take a look at that in a second. Tech, discretionary, industrials. Not seeing a huge number of movers here. Just going to take a quick check of our leaders and sentiment. K-Web is that Chinese ETF. We already looked at that board. EWY is Korea, EEM, emerging markets. So kind of a theme there. To the downside, ARC components and meme. Those are taking it to the biggest to the downside. I did promise a look at the bank screen. There you go, more red.
All right. Taking a look at some deep red for financials this morning, the banks specifically here. We'll continue to watch those. Let's also check in on another trending ticker this morning. Roblox, ticker symbol RBLX. It's lower following a downgrade from a Morgan Stanley analyst from underweight to equal weight, and they cited minimal advertising upside in the near term. The analyst also lowered the price target on Roblox from $27.50 now down to $24 here. One of the things pointed out within this analyst note, they're expecting slower growth to start in the second half of 2023. Also, more on that advertising nod that I mentioned a moment ago. They're expecting that immersive advertising will be a key growth driver in 2023, but expects the rollout will be too slow to support the stock. Now, Roblox stock, it actually was higher coming into this by about 28%, just ahead of this report year to date. And so the analyst also giving a nod to the fact that, even with that rise, they believe that the first half 2023 reacceleration had been fully priced in with more mixed catalysts ahead, they called it.
I had some fancy price action to chart here, but I can't pull up the chart. So regret that we're not able to do that. But just another note from the analyst he is preferring some of the competitors like Activision Blizzard. Well, we know they're in the midst of a takeover, and then Take-Two in the broader interactive entertainment space. So maybe not the right time for Roblox, but you got to think this is kind of one of those disruption / entertainment / maybe has some other hats kind of stock there that crosses a number of gray areas, a number of borders there. So we'll have to keep track of that.
Yeah, absolutely. And you're taking a look at Activision, which has largely been kind of sideways over the past year. Of course, we're almost reaching actually that 52-week point when Activision Blizzard and Microsoft announced that there was a deal on the table to combine the two entities and that Activision Blizzard would be absorbed, provided they get through a lot of the regulatory and the different committees internationally that need to greenlight this deal. And they still have needed to either talk about concessions in some regions and in others, just trying to figure out how they can appease some regulators that need to greenlight this to go forward. But I think for Roblox here, and this is a company that's going to be reporting their earnings just about this time next month, February 15th is when we'll get some updated results from them. So it'll be interesting to see if Matt Cost's call here and his projection that Roblox and the best being priced in, at least for the first half, if that is true, and what the company signals, what their outlook looks like, and what kind of forward guidance they give for the rest of this year's performance too.
And we will have to round out the discussion here by talking about Uber and the future of ride sharing and delivery heading potentially electric. Uber is working with automakers to design a low-cost EV for its ride-hailing business. And the company also said that they are considering smaller vehicles with 2 or 3 wheels and trunk space that leaves a smaller footprint. And Brad, I got to say, I think transportation, I think already it's kind of bifurcated. You have what you have to use in order to get from point A to B, making a few concessions, and then you got your ride in style. If you're in the city here and you have enough money, you can have that car. I personally don't have one.
I was going to say, can I say how you are mobile around the city? Can I tell our viewers that?
Please.
Jared has one of the most high-powered scooters that I have ever seen, and you're able to use what I believe the micro-mobility lanes. I've seen you zooming around in those.
Yes.
And you got to imagine for Uber, if they're able to do this successfully, and they're able to, because Dara Khosrowshahi had talked about a vehicle that has maybe 2 or 3 wheels and trunk space, that perhaps allows them that ability to use that micro-mobility lane a little bit more. And then you start thinking about what this means for the congestion fees that a lot of customers of Uber, either for a ride or for a delivery, that they may have to incur, and whether that would start to be rolled back or reconsidered. Now it depends upon the jurisdiction, obviously, but I think that could also have some type of pricing mechanism change too, that perhaps we can be a beneficiary of.
I think we're going to benefit a lot from all of this. The average person in a congested city, a congested suburb, wherever it is, this is going to open up, not just this, I mean technology in general over the next 10 years, going to open up vast numbers of opportunities to declutter our lives. And maybe we're all not going to own an SUV, but we're going to get from point A to B a lot more quickly and a lot more efficiently, I hope.
I've long been an advocate for New York City needing to be a golf cart culture type of city, like we see in Florida sometimes.
Scooters.
Yes, scooters, exactly. The rebuttal. Guys, coming up, slowing demand for vehicles, appliances, and really anything that carries aluminum as we dive into earnings from metal maker Alcoa Corporation next.
Alcoa stock down after the aluminum producer released its quarterly results. Revenue fell 20% year over year, and falling aluminum prices is the center of the discussion here. Ines Ferre is here to break down those results for us. Ines.
Yeah, Jared, and Alcoa reported a second consecutive quarter of losses. And part of this has to do with, as you had mentioned, falling prices when it comes to alumina, that's a compound, and aluminum. Also, the management talking about a challenging environment last quarter, higher energy costs, higher production costs. That prompted management to cut output on out of some of its plants in Spain and also in Norway. And we also saw weakness in construction. We saw weakness in Europe. We saw those China lockdowns. So really what happens with aluminum kind of indicates what's happening in the world when it comes to demand. And China dictates prices because more than 50% of the world's consumption is in China. So what does this mean? Well, the outlook is rosier because during last night's call with management highlighted China demand, and that is expected to improve in 2023 as China reopens. So that's a bullish story when it comes to aluminum, and also two sectors to keep in mind as well. Electric vehicles, fun fact that management put out there, 40%, electric vehicles require 40% more aluminum than gas vehicles. And also packaging, that is another sector that is also bullish. But when you take a look at Alcoa, the stock is down now 2%. And when you take a look at aluminum prices, the volatility that we saw with aluminum prices, last year in the first half of the year, you had aluminum hitting 4,000 per metric ton. Right now, it's around 26,000 per metric ton.
Wow, that's an amazing stat. EVs require 40% more aluminum. I didn't know that.
Exactly. So that's expected to be very bullish for aluminum going forward as the world goes towards EV.
Yahoo Finance's own Inez Ferre, thank you so much for breaking down the earnings for Alcoa this morning. Coming up, we head back out to Davos and the World Economic Forum as Brian Sazzi sat down with HP CEO Enrique Lores. Stick around.
All right, welcome back to the World Economic Forum here in Davos, Switzerland. We spent the whole week talking to a lot of executives, and one of them was a friend of the show, HP CEO Enrique Lores. He's coming off a very tough decision of having to lay off 12% of his workforce. I asked him more about that and the state of his business.
I think it's probably more positive than what we saw last May. Actually, I was telling the team when we came in May, the US delegation was more optimistic than the European delegation. This time it's probably the opposite, which tells about the different challenges that the different companies are seeing and the different geographies.
Do you think we're just making too much about a potential recession this year? There are a bunch of surveys that have come out. PwC said most CEOs, 73% of them polled, were looking for a recession this year.
I think it's hard to know what is going to happen, and clearly I'm not an expert. Mm-hmm. What is true, though, is there are significant challenges when we look at the impact of inflation, the impact of the war, the increase of energy prices, the situation in China. each of these things could drive for our recession. Hard to know what will happen. For all of us, what is important is to focus on those things that we can control. I think this is where we as CEOs can add value. And in our case, it's really about managing our cost while we continue to invest in the growth areas to position ourselves in the right way for whenever the economy will revamp.
There are a lot of moving pieces to this year, absolutely. As you frame out the year, what is the biggest challenge you're up against?
I think it's being able to do both because, as I said, we need to reduce our cost structure to be more competitive, but also we need to continue to invest in hybrid work, we need to continue to invest in gaming, in consumer services, and balancing that is the challenge we have, but we are optimistic that we will be able to do both and position the company for the future.
Speaking of cost reduction, you've made a big move. You to reduce 12% of your workforce. How hard is it to make a decision like that at this point in time?
It is always very hard because anything that has people implications are probably the hardest decisions we have to make as executives. But at the same time, they are the right thing to do for the success of the company. And what we need to do is manage them in the right way for the employees while we execute them for the future of the company.
Those cost savings, how do you reinvest them in the business?
We have identified 5 key growth areas. And what we have said is some of the savings will go to the bottom line. Some will also be used to continue to accelerate the growth in those areas, because this is where we see the future of the company. They represent now more than $11 billion, and we expect them to continue to grow in 2023.
Do you think the cost cutting is done? You've gotten everything out of the way that you need to get out of the way?
In a company like us, there are always opportunities to continue to reduce cost. When you have $60 billion of revenue, $50+ billion of cost, there are always opportunities to reduce cost, which is one of the strengths that we have, know how to identify that and execute on that.
You've really started to pivot the company to a hybrid work environment to support that environment. Take us through some of those initiatives.
I think first of all, we believe that the future of work is hybrid. We see the benefits for the company, we see the benefits for employees, and we see a lot of opportunities for innovation to make the right employee experience. If you think, for example, about the experience that the employees that are connecting to a virtual meeting are having when some of them are working from home, some are working from the office, clearly a lot of work to do to make sure that they feel integrated, they feel part of the meeting, they can see body language, they can be heard. That's an area where we are investing because we really see an opportunity to grow and differentiate.
I can tell you're having fun right now. I'm just studying your body language. It looks like you're having fun. We're still really cold, guys. I'm not making this up. It's freezing out here right now. Look, as we look into the back half of the year, I talked to one well-known tech CEO. I can't say because it was off the record, but they said the PC correction may not end until next year. What do you see?
What we have said is that we expect the inventories to be fixed by the first half of 23, and this is a big part of what is driving the correction, and the rest is going to be really driven by what happens with demand, what happens with economy, what happens with the recovery. Hard to predict at this point. What we are doing is working with multiple scenarios, as we said in our last earnings calls, and make sure that we identify the actions that we need to take depending on what scenario we see happening.
I was thinking back the other night, and when the pandemic first hit, I went to a Best Buy store, and I bought a lot of junk. Things that I just needed right away, $30 webcam, you name it, not good stuff. And now it's all broken, it doesn't work. Do you see a major refreshing of all of these products over the next few years because they don't work? And to your point, we may still be working from home in some component.
I do, and both the increase of number of PCs that were sold, but also cameras, displays, all of them represent an opportunity to be replaced. All of them will be replaced. We really think that people are going to continue to work in a hybrid way, which means sometimes working from home, sometimes working from the office, doing different things in the different locations. And clearly, this is a big opportunity for us.
I'm talking to a lot of leaders, and they all seem to be using Davos also not only meet with clients and drum up business, but rethinking how they lead as a leader. Have you had any just moments alone to yourself here thinking about how you may lead differently coming out the other side of this pandemic?
For me, one of the big benefits of Davos is really listening and listening what others are doing, what others are thinking, what others are feeling, and use that to really redesign the plans for the company, but also for some personal experience. So definitely yes, and I think this is one of the big values of the 4 days that we spent here in the cold.
Good life advice there from HPCO Enrique Lores. Talk less and listen more. All right, coming up, we'll go from hardware to software with a Netflix preview from another friend of the show, Ali Canal. We'll be right back.
Welcome back. Netflix earnings are out tonight with some investors keyed into one critical question. Just how many subscribers or subs does the streaming giant have? The Street hoping for 4.5 million new ads this quarter, and alongside, of course, the performance of its new ad-supported tier and in-house content. Now, we have Ali Canal here with more. Yahoo Finance's own. Ali, what are we expecting?
Yes, and this is going to be an important quarter for Netflix to really set the tone for this new year. Because if we remember this place last year, 2022, we started the year with 2 straight quarters of subscriber decline. So Netflix is really going to want to come into this with a position of strength. Investors are going to want to see some updates on Netflix's profitability efforts, which does include their recently launched ad-supported tier, along with a crackdown on password sharing. However, analysts have told us that investors are going to have to play the long game there. It's likely that we're not going to see the full impact of those efforts in this quarter, especially since the ad tier just launched in 12 markets in November. However, we have received some third-party data that shows ad-supported subscribers make up about 12 to 15% of that global gross subscriber base. So perhaps we'll see some more color on that earnings call later this evening. Let's just go back to those numbers real quickly and what we're expecting from the Street. Revenue expected to come in at $7.85 billion, adjusted EPS 58 cents a share, and as you mentioned, Jared, those subscriber net additions 4.5 million, and that's something that Netflix has guided as well. However, some analysts are upping and boosting those subscriber expectations due to the fact that we saw some pretty solid content this quarter, record-breaking content from Wednesday, Glass Onion, Troll, the list goes on, and we're going to see continued content improvements planned for this current quarter as well. So while those subscriber numbers, it's not the be-all, end-all anymore for investors. They are really focused on profitability. A subscriber beat would be a huge win here. And real quickly on the revenue front, we know that the strength of the US dollar has been a big pain point for Netflix. However, that dollar has been weakening a bit, so we could see some positive momentum there for both revenue and operating income. And then finally, just take a look at this stock price, because Netflix stock has been on a tear in recent weeks, recent months. It's up about 8% year to date, up about 60% over the past 6 months, and it's far outpacing the Nasdaq Composite's 0.5% gain on the year. So we'll have to see if that upbeat stock can continue after earnings.
All right, you mentioned all of those key titles. Let's talk about their spend, because the billions of dollars that go out the door with regard to just creating some of those names that become household titles, whether in movies or series. What do we expect to hear on the original content spend front from Netflix?
So Netflix has guided that they're planning to once again spend around $17 billion this year. So even though it's roughly on par as what they spent last year, it's still important to note that they're not increasing their spend, because Netflix really was the pioneer in this. They just constantly wanted to pump more money into their original programming. We saw a lot of other media giants, a lot of other streamers adopt a similar type of strategy. Disney, for example, spends around $30 billion in content annually, but we're seeing a pullback across the board. Again, all going back to profitability. We will see if there's any updates. Maybe they'll lessen that spend over the years, but I think that 17 billion number is probably the one that's going to stick. But right now, I think the content slate has improved. I think that's going to help with subscribers, help with that newly launched ad tier. I'll have to wait and see.
Yahoo Finance's own Ali Canal going to be keeping close tabs on ticker symbol NFLX after the closing bell here. Thanks so much, Ali, for breaking down the earnings expectations. Coming up, we reset the show, take a look at some recent remarks from Fed policymakers, and we're going to dive into even more earnings right after this. Welcome back to Yahoo Finance Live. It is Thursday, January 19th here in New York City. I'm Brad Smith with Jared Blickery. Let's take a look at the markets 30 minutes into today's trading session. We've got the Dow, the S&P 500, and the Nasdaq all in negative territory, and keeping a close eye on some of those fractional declines here on the day. The Nasdaq is leading the charge to the downside, though. For the tech-heavy average, you're seeing declines of about 0.8%. We've got more on that in just a moment. But here's what's on tap for the rest of this hour. A mixed quarter for Procter & Gamble, with shrinking consumer demand offsetting higher prices. We're going to bring you the details there. Plus, we're heading back to Davos. Julie Hyman and Brian Sozzi spoke to Cisco CEO Chuck Robbins. We've got the full interview on deck. And running out of millions, Usain Bolt shockingly missing $12 million from his account in a reported scam. We're going to chat about this one in today's Cut for Time. But Jared, let's kick things off for this hour with a deeper dive on the markets.
You bet. And here we have ourselves in the midst of a two-day decline. The losses range from the Dow about 57 basis points or 0.5% to the downside, to the Russell 2000, 83 basis points or 0.8%. And I want to take a look at the VIX here. I haven't taken a look at that in a few days, and this is over the last 6 months. Over the last 5, 6, 7 sessions or so, it has picked up a little bit, so we want to keep an eye on that. And that's in the midst of a sell-off, at least a two-day sell-off, as I said, with the S&P 500. The Nasdaq really the most bearish looking of the group, just kind of chopping around in the lower end of its range. Got to get to the bond market. Not a lot happening today after yesterday. Yesterday we saw some fireworks, that big drop in the 10-year to a 4-month low, and today we were just bouncing up about 2 basis points. Just a fractional move that we want to keep an eye on there. Finally, the U.S. dollar index, that is hanging out by its lows. Again, this is a 6-month chart, so not making any ground recently, but not losing it either. So decent setup for risk markets potentially. Then we got real estate and healthcare in the green today. Those are the S&P 500 sectors, a little bit of a defensive setup. And then financials taking the biggest hit to the downside. That's XLF down 1.2%, followed by industrials, materials, and consumer discretionary. And just taking a look at our leaders, the top performer are going to be found in China. We'll take a look at that heat map in a second. And then the biggest losses can be found in TAN. That is a solar ETF, followed by ARC, cannabis, chip stocks, retail. So some of the biggest winners this year have been giving back those gains over the last 2 days. Easy come, easy go. Did promise to get to those the bank screen here. We have Capital One, that's down 5.5%. We were looking at Discover earlier, that was down. Truist Financial, that is up 2.8%. Everything else here in the red. And as economic data rolls in, investors are also navigating recent remarks from Fed policymakers. And we have Yahoo Finance's Jennifer Schonberger here with the latest. Jen.
Hi, Jared. This morning we heard from Boston Fed President Susan Collins, who says she expects further rate hikes from here, though at a slower pace. Pointing to still high services inflation driven by wage growth, Collins, speaking at the Boston Fed this morning, said, quote, "There is more work to do. I anticipate the need for further rate increases, perhaps at a slower pace, depending on incoming data, before holding rates at a sufficiently restrictive level for some time." Collins says she thinks rates, which stand in the range of 4.25% to 4.5% right now, will need to be raised to just above 5% before holding them there for some time. She says rates are in restrictive territory already and that we may be nearing peak, so it makes sense to raise rates at a slower pace so as to balance the risks of bringing down inflation versus pushing up unemployment by a lot. Now, similarly, Dallas Fed President Lori Logan, on a similar page as Collins, speaking last night in Austin, Texas, Logan says she wants to slow the pace of rate hikes as well to make sure the Fed walks the tightrope of reining in inflation while not sinking the economy. Logan saying, quote, "That's why I supported the FOMC's decision last month to reduce the pace of rate increases, and the same considerations suggest slowing the pace further at the upcoming meeting. To be clear, I don't see the argument for a slower pace as depending very much on the latest data. A slower pace is just a way to ensure we make the best possible decisions." Now, Logan says she's watching financial conditions and says if they loosen, the Fed could always raise rates further, even after pausing them. Now, yesterday we heard from Philadelphia Fed President Patrick Harker, who also is in favor of slowing down rates to a pace of 25 basis points at the next meeting. Though St. Louis Fed President James Bullard reiterated yesterday he wants to put the pedal to the metal, implying perhaps 50 basis points at the next meeting, though he is not a voting member. We will hear this afternoon from Vice Chair Lael Brainerd. Guys.
All right, Yahoo Finance's own Jen Schomburger. Jen, thanks so much. Appreciate it.
Thanks.
Shares of Procter & Gamble, we've been tracking those this morning. They took a tumble following its latest earnings release. P&G posting a slight miss on its profits as sales volumes declined and higher prices of its products weigh on consumers. For more on this and the state of the consumer and consumer staples, let's bring in Peter Grom, who is the UBS U.S. Household and Personal Care Analyst. Great to have you here with us this morning, Peter. I want to get your take, first and foremost, on this earnings release from Procter & Gamble, and notably on the volume decrease there, especially given some of the pricing mechanisms that the company had to roll out.
Yeah, thank you for having me. I think what I would say is this quarter, had some good and had some bad. I think, on the initial reaction, the minus 6% volume was a bit disappointing, certainly versus our expectations and also versus street expectations. However, we felt the company did a very good job on the conference call this past hour, outlining the reasons behind that. First and foremost, they outlined, Russia, which was a 100 basis point impact. And they also discussed, inventory destocking at retailers. In other words, shipments are not matching consumption, which was another 200 basis point headwind to volume. So, on a like-for-like basis, the volume of minus 6% is more like a minus 3%, which would have been closer to our expectations. And so I think at the end of the day, consumption remains strong and not as bad, and elasticities are holding up better than we would have anticipated.
Peter, you mentioned being on the call and listening in. Give us a sense of the tone on the call and what you would recommend to investors who have either been tracking P&G or might be investors in P&G, given that tone that you're taking away from what executives are seeing going on throughout the rest of 2023 in the consumer environment right now?
I think it's a mixed bag. In the United States, the tone was still constructive. Consumption remains strong. The pricing environment remains favorable. Procter & Gamble discussed, the intention to take more pricing. I think, in emerging markets, places like Latin America, trends still remain strong. I would say, the two, key watch points would be Europe, which they pointed to some softer demand given the macro weakness there. And I think just the uncertainty on China. The company is expecting a more gradual recovery, but the visibility and the uncertainty remains. And I think that will kind of dictate, those would be the two key watch points, I would say, looking ahead.
Did you get a sense on the call that the management there feels that inflation has finally peaked, maybe goods inflation going to see that big decline this year? And I'm just wondering if they were concerned at all about labor costs. Now, they're not going to be concerned about that from the same standpoint as a services business, of course, but just wondering how these two components of inflation are interplaying in their outlook.
Yeah, so the company actually provided an update on their commodity inflation, which moved down marginally by roughly $100 million. Now, it's still quite substantial on a year-over-year basis, but it has moved down sequentially, probably for the first time in 2 to 3 years. So the company discussed on the conference call that they are starting to see input costs moderate. They highlighted pulp, resins, et cetera. So that they are starting to see the cost trend in the right direction, but there are still other costs that remain sticky. Labor might be one of them. In addition, there's other supplier costs that they are dealing with that remain elevated. So I think things are trending in the right direction, but there's still the magnitude and pace at which costs can moderate is still a bit uncertain.
We had on Matt Maley a couple weeks back, I believe it might have even been last week, who had said that if consumers are clearly opting in for prices on discounted basis, then that would tell you that the consumer is not as healthy as what some banks and what some consumer staple companies may even be saying about the consumer, because they're accepting product at lower price. And so with that in mind, for the consumer of a company like P&G, when can they expect a normalization of prices?
Yeah, that's a great question. I mean, I think the thought process moving forward is that while they still are going to take additional pricing in certain markets where it warrants additional pricing, particularly around FX related pricing, I think you're starting to see a normalization in pricing moving ahead. We are going to start to lap the outsized high single digit increases that we've seen in this sector, as we move into the back half of the first quarter and into the second half of this year. So that will be, we would expect pricing to moderate. That's what we are forecasting more broadly. I think the key question moving forward is what happens with volumes. We've seen volume elasticity hold up better on the way up. The question becomes, will volume growth resume as the year-over-year rate and pricing increases lessens? And I think that's kind of the one point of uncertainty as we think about category growth as we look out to the back half of the year. And I think Procter & Gamble on the recent earnings call basically outlined that they expect category growth to moderate, largely because pricing will become less of a driver moving forward.
And just thinking about some of the categories here, just noting that grooming organic sales grew by 0%. I noted that earlier in the show. Just wondering if there's any color you can add there. Maybe it was discussed on the call. That and also baby feminine and family care organic sales missed expectations by a little bit. Any thoughts into what we can expect with those couple categories going forward?
I mean, so grooming, it's a wide range of product categories, and within that, you certainly have the everyday use function of the category, but you also have more of a durable nature in terms of razors and electronic razors and things of that nature. That's likely what we were seeing in terms of weakening demand in some of these categories where consumers are maybe extending the purchase cycle of some of these products. In baby fem care, the company has been dealing with some supply chain issues in fem care, so I think that has more to do with it than necessarily an indication of around where demand is going.
Peter, just lastly, while we have you, we only got about 30 seconds here, but are there any winners on an outsized basis that you look at within consumer staples right now from a stock performance perspective, and where do you place some of those expectations even with the consumer environment that we've been discussing?
That's a great question. I think from a sector perspective, this is really going to come down to what happens from a macro perspective. And I think within that context, if we are, in fact, heading for a recession, history will show us that consumer staples will outperform both heading into and during. And so I think it's going to be more of a broad-based group call. However, what I would say is that there's some things that have moved more favorably. I think, commodity costs moving lower is certainly a benefit. And I've also would highlight the weakening of the US dollar. So I think companies like multinationals could potentially benefit here. And I think companies that have seen significant margin contraction, like a Colgate, could stand to benefit as we look out to 2023.
Interesting how so many things come back to the old greenback here, the US dollar. Thank you for that, Peter Grom, UBS US Household and Personal Care Analyst. Trending ticker time. Piper Sandler reiterating its outperform rating on Tesla ahead of the EV maker's earnings anticipated for later this month. Piper Sandler noting that pricing adjustments they have been made and valuation has reset for Tesla. While that's happening, investors should be proactively buying the stock. Tesla shares currently trading a little bit to the downside, although we're going to call that flat. Coming up, Bed Bath & Beyond continues to explore options as bankruptcy talks intensify. That and much more when we get down to business. Up next.
Welcome back, everyone. Among the top stories that we're following for you today, New Zealand's Prime Minister Jacinda Ardern is stepping down within the next 3 weeks. In a tearful statement, Ardern said she did not have, quote, enough in the tank, end quote, to continue leading the country. Praised for her handling of the pandemic and her response to a 2019 terrorist attack on Christchurch Mosque, Ardern brought much popularity to the Labour Party, though more recent polling placed support for her and her party at its lowest level since 2017, as frustrations over rising rates, crime, and the cost of living continue to mount there. And Elon Musk is nearing the first interest payment on the $13 billion in debt that he took on to buy Twitter. According to the Financial Times, that is. That payment could be due as soon as the end of January. Bloomberg reports it's expected to total $300,000. And Musk said Twitter had $1 billion in cash on its balance sheet in late December. More than enough to make the payment. Still, anxieties remain around the measures Musk may take to ease Twitter's debt burden after he floated the idea of bankruptcy. And meanwhile, Bed Bath & Beyond is in talks with potential buyers as it looks to keep its chains open, according to CNBC. At the same time, it's also looking for a lender to keep the company afloat if it were to file for bankruptcy in the near term. A Bed Bath & Beyond spokeswoman said Wednesday that multiple paths are being explored, and we are determining our next steps thoroughly and in a timely manner, end quote. Jared?
Embattled oat maker Oatly getting some applause from analysts at Mizuho. With shares down more than 60% over the past year, the Japanese bank is stepping off the sidelines and upgrading Oatly stock to a buy rating with a price target of $6. And that's a 123% increase from yesterday's close and a level that hasn't been seen since early 2022. Now, for more on this bullish call, let's get to Mizuho's senior consumer equity research analyst, John Baumgartner, joined by Yahoo Finance's Brooke DePalma. Thank you both for joining us. And let me start with you, John. What's behind this upgrade on Oatly?
Well, there's really two parts to it. One, we think from a company perspective, we think bearish sentiment has peaked, fundamentals have bottomed. We expect after a pretty tough 2022 where the company was held up by some supply chain constraints, which limited top line growth, commodity inflation, the zero COVID lockdowns in China. In 2023, we expect supply chain acceleration, new distribution growth, acceleration in Asia from the improved COVID situation in China, as well as better commodity costs, and also an improving liquidity trajectory for the company into 2024. The second component to the call is the category. At this point, just given the hardships beyond meat and the plant-based meat category have had, investors have really soured on the plant-based theme in general, but we think plant-based beverages are much different. The category grew 10% in 2022, very limited elasticity. We see significant room for per capita consumption growth in the U.S. over time, as well as further growth outside the U.S.
So now let's go into that category conversation there. Can you sort of break down, you still have a neutral rating on shares of Beyond Meat. As you noted before, you upgraded Oatly to a buy. Break down exactly what that consumer sentiment is for plant-based meat and just how vast it differs from plant-based beverages.
Well, I mean, we think the category is really, you had a pull forward of demand with the COVID lockdowns in 2020. Your category goes up 45, 50%. You've seen 24 straight months of consumption declines for plant-based meat. We think you've had your first generation of consumers adopt the category, and we're waiting now for the next phase of innovation, better quality products to roll out. So we like the plant-based meat category over a 10, 15-year period. We continue to see very limited consumption growth for the short term. Now, in contrast to that, thinking about plant-based beverages, there's many more consumption opportunities. You can use it as a milk replacement in cereal. You can drink it as a beverage. You can use it as a coffee creamer. You can use it as an ingredient. So for the beverages category, I mean, you can see 4 or 5 consumption opportunities per day in some cases for these categories. It's not a center of plate option like plant-based meat is, where your consumption opportunities and the intensity of consumption are limited. So we think there's a big difference there. You also have the lactose intolerance consumer helping drive the growth of plant-based beverages. You don't have the equivalent of that in plant-based meat. There's also a much larger food service component as well in coffee shops, in Starbucks, supporting the category growth in beverages you haven't yet really tapped into on the plant-based meat side.
They also benefited from some star investors, even prior to going public, people like Oprah, people like Jay-Z, Where has that kind of petered out at this point? Does it still have that same appeal to consumers to say, oh yeah, I know that there are some big names surrounding Oatly. Does that still kind of push a consumer to trade up or buy up to an Oatly versus perhaps some of the other trade down brands in a grocery store?
We don't really think so. We think what it really comes down to at the end of the day is price and taste, and functionality. And you can argue that for plant-based meat, for plant-based beverages, as long as the price is competitive on the shelf and the taste and the functionality are there, we think that really drives the category. And what's interesting for plant-based beverages, if you look at it on the shelf, organic milk is about 15% share of the category in volume terms, and plant-based beverages offer more of a mid-priced product between conventional milk and organic milk, which slots in more favorably in a consumer decision set at the shelf. Whereas plant-based meat, there really is no real organic product there. So the price premium looks a lot more impactful relative to your conventional meat price, and that's also been a detriment and to plant-based meat and a benefit for beverages.
And bringing it back to Oatly, of course, they recently announced a long-term partnership with the IF Foods in North America. What do you think this means for Oatly's bottom line and ultimately growth here in the North America side of operations?
We think it's a big change. Dating back to the IPO, Oatly's strategy long-term was to increase the share of self-manufactured internal volume, with the view being that you have better control over the supply chain, you have better operating leverage, which is fine, but it comes at a cost of big capex going forward. And that was the issue in 2022. There was about a $500 million cash burn on the cash flow statement before it's all said and done. Yahoo coming in as a hybrid manufacturer now allows Oatly to split capex with a partner. So it really reduces capex going forward in 2023 and in the out years. We think you could have a capex savings of up to $100 million relative to the base case here in 2023. That significantly reduces cash burn, improves the liquidity profile going forward. We think that puts a bottom in fundamentals as well.
And last question here, commodity relief is something that you noted, with particularly in relation to oats. This comes as the company raised prices last year. What we're hearing on the street is that here we see higher prices hitting consumers, but lower prices when it comes to commodities. What do you expect that this means for the company's quarterly results coming up?
We think, in Q4, you're going to see, sort of the lagged impact, more pricing coming through, playing catch up to the inflation that was, probably mid to high teens in terms of cost of goods sold in 2022. Looking forward, we're definitely seeing inflections. We're seeing oats prices actually turning deflationary, both in the U.S. and in Canada. We've seen, better crops over the past year. So oats and rapeseed oil, those are about 15% of Oatly's total cost of goods sold. They were most inflationary last year. There should be tailwinds going forward. So for 2023, we still think the company faces inflation, but more manageable, probably more high single digit, in that respect. And at the retail shelf, what's interesting, when 2022 first started, the jury was out in terms of plant-based beverages as a staple versus discretionary product. And what we found was, even with the category raising prices 12%, volume was only down 1% to 2%. So in terms of elasticity, plant-based beverages are really on par with cow's milk, soft drinks, bottled water. So it really proved itself as a real staple category over the past year.
John, I got to hustle to my finish here, but when you think about Beyond Meat, because you also cover this company too, does plant-based meat make it through an environment where consumers are bucking higher prices and perhaps even trading down to other meat alternatives?
We think it will. I mean, there's about 200 brands that are out there. So we think you're going to see consolidation of these smaller brands, real shelf consolidation at retail. The big brands that are out there, whether it's Beyond Meat, Impossible, Morningstar, we think those remain the big brands going forward. And after this period of consolidation, we expect new entrants to come in over the next few years with next generation R&D, next generation ingredients, processing technologies to continue to drive the quality experience, to improve it over time for the meat category.
Disrupting the meat disruptors in the future. I like it. Thank you for that. Have to leave it there. Mizuho Senior Research Consumer Equity Research Analyst John Baumgartner. Coming up, robbing Peter to pay Paul. We check in with the latest from D.C. and what you should know as the debt ceiling deadline looms. Stick around. Welcome back. A shaky economic outlook, a gloomy housing market, and a never-ending debt ceiling debate. You'd be forgiven for thinking we're back here in 2011, but we're not. And the brinkmanship has returned, however. Democratic Senator Joe Manchin back in the headlines. He looks to be seeking a deal with the GOP over spending, which puts him at squarely the odds with the White House. Yahoo Finance's Rick Newman has the story. Rick.
Right, so we're going to be having another twist in this debt ceiling farce, is what I call it, just about every day for the next 4 or 5 months. And nothing is going to get resolved until we're right up to the deadline, which will probably come around mid-June or early June. But here's the twist du jour. Joe Manchin, the moderate Democrat from West Virginia, says, hey, here's how we can address the spending issues that Republicans are raising. Let's form a commission that is going to figure out what we should do about the reality that Social Security and Medicare eventually are going to run short of money. Now, Republicans in the House are not going to buy this because they don't want a commission. I mean, when you really just want to put off an issue forever in Washington, what you do is you form a commission. The way these work is Congress would then vote on the commission's finding. It would be either be an up or down. You'd vote on all the committee's recommendations. One way or the other, you can't modify them. We've seen this before. Congress never adopts these measures. So this is, one of probably what are going to be dozens or hundreds of ideas for what to do about the debt ceiling impasse. But we're not going to get an increase in the borrowing limit again until the last minute because the small group of House Republicans for whom this is a do or die issue want to go to the mat on this when they think they'll have maximum leverage.
Yeah, just in this morning as well, the Treasury Secretary Janet Yellen has addressed another letter here to Kevin McCarthy, House Speaker Kevin McCarthy, saying that because of the back and forth here that you were just laying out, Rick, that they're going to be unable to fully invest in the portion of the Civil Service Retirement and Disability Fund required to pay beneficiaries, and that a debt issuance suspension period is going to begin today, Thursday, January 19th, and going to last through June 5th of this year as well.
So what she's saying in plain English is we have hit the federal borrowing limit. So the federal government now cannot borrow any more money in total. It can issue new debt as old debt matures, but the total amount of borrowing cannot go above where it is right now. So if the Treasury Department were not able to basically move money around and come up with some extra cash to pay bills, that means that some of the government's bills would simply go unpaid. And we will get to that point, but we've got, let's call it 4 to 5 months here where the Treasury can move money around. And assuming this does get resolved at the end and the borrowing limit goes up and there's no catastrophic consequences, then the Treasury will be able to replenish, kind of repair all these things. But for the meanwhile, for about 4 months, we're going to go through an exercise in madness, which is how close do we want to come to the U.S. government can't pay its bills?
All right, excellent insight and analysis, and hopefully we don't have to endure too much of that madness. Rick, thanks so much for breaking this down for us. Appreciate it. Coming up, we're going to head back to Davos, Switzerland, where the madness there is, well, maybe the cold weather. Brian Sazi and Julie Hyman sitting down with Cisco CEO Chuck Robbins. You do not want to miss that.
Welcome back to Yahoo Finance's coverage of the World Economic Forum here in Davos, Switzerland. And again, all week we've been talking to some of the biggest names in business. And one of those big names is Cisco CEO Chuck Robbins. Here's what he told us on tech layoffs and who he's been meeting here on the ground.
I've met with lots of CEOs. I've met with a couple heads of state. I've met with the First Lady of Ukraine. Met with Vice Premier Liu and it's it's funny because publicly in the press, everybody wants to talk about whether we're going to a recession or not. When we go into our meetings, we generally don't talk about that. There's a lot of discussions around Ukraine, obviously. There's a lot of discussion around geopolitical issues. There's a lot of discussions around inflation in general, the energy crisis, but I think overall, I sense there's still more optimism here than what's sort of being portrayed relative to this fear of a recession.
You met in the meeting with China's vice premier. What are some of your takeaways there? Is that relationship between the U.S. and China as fragmented as we all make it out to be?
Well, my takeaway is that after Xi and Biden met at the G20, it feels like both sides are at least going to begin some discussions again on some really important topics. And Vice Premier actually talked about that while he was here. So his messaging with us was quite similar to his public messaging here. So I'm optimistic because the uncertainty is what is the problem out there. And I think that, look, we're going to compete. They know they're going to compete. We're going to compete. But we need to find a way. There's some issues that we need China and the U.S. to agree on and work together on, like climate. But there are areas where we'll obviously compete, but we need to find a way to do it in a way that doesn't destabilize the global economy, and that's what I'm hopeful for.
You know, I'm curious when I hear you talk about that, there obviously is the political dealings between China and the U.S., and then there are the business dealings. How separate are the two? How much are you influenced by if there is tension between the two? Are you still able to get deals done, for example, when things are at a more tense point?
Yeah, the only thing that really affects how we think about it is regulation, right? So, I mean, there's always going to be noise, and I think most of the CEOs here have grown into their executive career and their CEO positions in times of crisis, and there's always something going on, and we're just kind of used to it. And so there's always going to be noise, but you just deal with things once they become reality. Now, you can plan for most likely outcomes, which we will do, but none of the rhetoric has really affected how we think about doing business around the world right now.
Do you have to get leaner, Chuck, on expenses and employees, given what you are seeing on the economy and what everybody's talking about here?
No, we're actually going to exit this year spending more in expenses than we did coming in. If you go back to the beginning of the pandemic, we've been very thoughtful about how we've added expenses through the whole pandemic over the last few years. So we're in a reasonably good position. We are investing heavily in cybersecurity right now, so we are reducing our costs in other areas, but we're pumping it, into cyber and a few other areas because obviously cyber is that's another one of the big discussions here this week.
Does it feel to you like most of the cuts in big tech have happened, that we're now moving to a different phase of that cycle, or do you think there are more to come?
It's hard for me to say. I mean, there was some news out today about Microsoft, so I think that I haven't seen anything official from them yet, but I think it's pretty difficult to say. I think the next couple of quarters are really going to tell us what's really going to happen in the economy, and I think that'll determine the answer to your question.
Cisco's an acquisition machine, and there's been some talk about you eyeing your next big potential deal. Is anything imminent, and where would you possibly be looking?
Who's talking about that?
I hear things, Chuck. I hear things.
Look, the M&A world has been pretty quiet for about a year, as is evidenced by some of the investment banking numbers that we've heard from the banks. I think a lot of the possible targets for us in M&A had very high valuations. And we all know that those valuations came down pretty significantly 12, 14 months ago it began. And I'm hopeful that now that some of those great companies out there with incredible technology, I think a lot of them are coming to grips with the fact that these may be more real valuations than they had hoped. And as they look ahead to the next 12 months, I think it also could indicate, they look ahead, they don't see necessarily a definitive bright light ahead. So maybe they'll be more open to, reasonable conversations, but we'll have to see.
Are there particular places in the business where you want to add on?
Yes.
Do you want to tell us what they are?
Look, we talk about cybersecurity. We're doing a lot of organic work. There's always opportunities for inorganic there. There's an emerging area called full stack observability in this world of new application architectures. There's a lot of opportunity there where we have incredible organic capabilities as well as possibility for inorganic. There's IoT. There's all sorts of options out there.
You know, we were at a party that you held the other night, and you were talking about.
I held a party?
The company held a party anyway, so I'll say it to you. And I got a sense of you as as a human, not just as a CEO. But what you were talking about, sort of some of your philanthropic work, et cetera, also illustrates what Davos sort of straddles, right? The business side of things, the geopolitical side of things, and then the philanthropic side of things, and trying to make the world a better place. Like, how do you think about that duality and how you spend your time and what you want to be spending your time on?
Well, I think it's important that wherever we operate, that our communities are healthy. And so we embarked on this years ago. We were doing a lot of this stuff before the whole notion of stakeholder capitalism. But I do think we live in a world today where our employees want to know us as humans. Our employees really care about culture. They care about your purpose. In fact, if you look at some of the latest surveys, I mean, employees will tell you that salary is not number one anymore. It's important. It has to be reasonable and it has to be great. But the culture and what you stand for as an organization really matters. You had the Edelman Trust come out again that actually said the CEOs in the business community are more trusted than government leaders again. So that we have our employees are asking us to be responsible. And so it's an interesting set of dynamics that we have to navigate. That when I took the job, I wasn't aware we were going to have to navigate all of them. But I think the philanthropic side and giving back to our communities is just we need healthy communities. We need housing, affordable housing. We need firefighters who can afford to live and raise their families. We need teachers to be able to afford and live in the areas, and that's why we got involved in housing and homelessness in San Jose. And I just think it's an important part of what companies need to do.
You know, and that last answer is so interesting to me because, again, it kind of encapsulates Davos, right? There is all this criticism, these guys are controlling the world. The CEOs think that they're trying to do good. And whether they're trying to do good because it looks good or because it creates a culture that is attractive to workers, if the effect is that they're helping homelessness in San Jose or whatever it is, does it matter? I don't know. It's sort of a philosophical question, I guess.
No, I'm glad you asked it, Julie, because we've been trying to humanize a lot of these executives here at Yahoo Finance this week, and we've had some really interesting conversations. And I'll also just add on what Chuck said about acquisitions. This was a different vibe in the Congress Center. Usually the Congress Center is when a lot of the executives, they float around, they get their coffee, get their Danish, get some other various snacks. We didn't really see a lot of executives in there. And I'm told, and you've been hearing it as well, a lot of these executives, this is the first time they were able to get FaceTime with key leaders in their own industry and around the world. A lot of more meetings this time around. I do think the top 5 deals this year will in some form trace back to this World Economic Forum. That's my big call.
Theory. We're going to hold you to that, as we do.
Please do.
To everything you say, Brian Zazi. That does it for us from here now. We'll be back with more later. Keep it right here on Yahoo Finance.
Home prices have come down in recent months as buyers get discouraged by high mortgage rates and rising costs. However, sellers are locked into sub or near 3% rates thanks to the buyer-friendly lending environments of 2020 and 2021. This gives them valid reasons to stay put with their purchase. Now, with forecasters calling for a recession, let's get to CoStar Group's chief U.S. economist, Christine Cooper, for more on this housing deadlock. And Christine, great to see you here. Let's just go over some of the economic data that came out this morning. Housing starts a little bit better than feared, I would say, and then building permits just kind of falling off a cliff again.
Yeah, that's right. There doesn't seem to be very much appetite right now for building new homes. The market has essentially been frozen for quite some time. We have inventories at very low levels. Builder starts have been slowing, as you noted, and completions have been also very slow. We only have had 8.5% increase, are down 8.5% year over year in completions of homes as builders have struggled during the pandemic with supply chain challenges and labor shortages to complete homes. And that's just resulting in sales slowing as well. We've seen this market cool. 35% lower number of sales over year in existing homes and 15% lower in new homes. So this is a market that still has a way to heal, and we'll be struggling for a little while longer.
Christine, what are the major indications that you would look to really establish that the housing market is rebalancing?
So, well, I mean, we have to see a more, like I say, a balanced market. Right now, the sellers and buyers are not agreeing on prices. Sellers still are expecting to see their home sales at a higher price than the buyers are willing to pay. Buyers have been locked out of buying homes with higher mortgage rates and higher prices. Home prices have doubled since 2014. They're over 40% higher than they were before the pandemic. So that's really impacted affordability, and buyers are being priced out, and they just can't make those purchases. Now we are seeing mortgage rates have declined more recently. They backed off of their peak that they reached, 7.1%, now back down to 6.3 or so, depending on the indicator that you're using. So once we see the affordability improve, then we'll see more buyers be able to purchase homes. And the same thing as we see mortgages rates decline, those locked in existing homeowners will be more likely to refinance or be more willing to move. And the spring season is coming up. We hope to see some improvement in the market coming up.
Improving supply chains are one critical measure for home builders, but then additionally, you think about the necessary materials going into those houses also coming down in price as well in order to make up that home. I mean, when you think about that calculus, what does that signal to you in terms of when some prospective home buyers can perhaps anticipate that there will be a more favorable market?
Well, so this is in the new homes market, right? So builders have been, over the pandemic, they've been faced by these challenges. Materials supplies were constrained. The prices were increasing quite quickly. Those prices are coming back down, and the supply chains are easing. A lot of the supply chain constraints are improving. So that will help builder margins, and it will allow them to be able to deliver homes a little bit more easily than they have been during the pandemic. And that will hopefully it'll bring cost of construction down, and like I say, builders will be more able to complete homes and provide a little bit more on the inventory side of it.
CoStar Group's chief U.S. economist, Christine Cooper, thanks so much for taking the time with us this morning.
Thank you.
Coming up, everyone. Running out of millions, Usain Bolt is shockingly missing $12 million from his account in a reported scam. We're going to chat about this one in today's Cut for Time, coming up next. Welcome back, everyone. It is time for Cut for Time. 3 stories, 1 minute each. We start with this today. Olympic legend Usain Bolt says that over $12 million is missing from an account that he had with a private investment firm. Lawyers for Bolt say that his account now only has $12,000 left in it and are prepared to take the case to court if necessary. Now, here's what they're saying about this. If this is correct, then this is a serious case of fraud larceny, and they have also said that there will be civil and criminal action if not returned within 10 days as well.
Nobody likes to open up their account and find a couple zeros or 3 or 4 zeros lopped off here. Got to do the math. I think it's a sign of the times here. It's no coincidence that we are in the midst of the greatest economic contraction of probably the last 40 years. Liquidity is low worldwide, and anybody who can get their hands in a mad dash for cash, and if they have to repay other debts, and I'm talking about fraud here, they're going to dip their hands where they can. And so, unfortunately, ease of access in this environment may give people the incentive to do that.
Fun fact, he's the only person who I've ever seen ride a scooter on the floor of the New York Stock Exchange. I thought you would like that one, yeah.
All right, and soccer legends Lionel Messi and Cristiano Ronaldo are set to square off in a match this Thursday, and one fan is paying $2.6 million for a VIP ticket to the game, and that's according to ESPN. The ticket, which was auctioned off, also includes a chance to meet the two players. And Brad, you are the mystery buyer?
I am part of a DAO that is buying the ticket, yes. But no, you think about what fans wanted to see over the course of the World Cup, and this was the matchup that everybody, of course, was just waiting for. And off of the fandom of FIFA, and now for another big match on the pitch, some lucky buyer who's got that money, not my DAO, to put up, is essentially just saying, you know what? Yeah, this is. I just wonder where the seat is at. I don't think I got that detail when I was.
Well, I would say there's an interesting time. It kind of reminded me of what Warren Buffett does every year. He auctions off for charity, a chance to sit down at lunch with him and shoot the stuff, see what's happening.
Has anybody paid this price?
2.6? I don't know. It's been in the millions.
Yeah, it has. All right, lastly here, let's talk about users of payment platform Zelle. They reported an outage on the system Wednesday, claiming some money has disappeared. Some took to Twitter to point out that this issue was specific to Bank of America users. Zelle also similarly said that and echoed that in their reply to some Twitter users. We also know that this caught the attention of one Senator, Elizabeth Warren, saying that Bank of America and Zelle are apparently failing customers again, with money somehow disappearing from accounts that should be fixed immediately, and customers should be compensated. She's called out fraud issues on Zelle in the past, and she said that this is their latest failure here.
More disappearing money, more fraud, but I don't think, not on behalf of Bank of America. And it might just be a glitch. And I'll tell you what, that would be perhaps even more troubling, because given the state of fintech, given all the money that banks have plowed into R&D in the space over the last decade, all they could come up with was Zelle, which is a decent product. But I mean, when you consider that Venmo came out way before and the banks were playing catch up, I just think that the bank could do so much more if they really put their heads to it.
All right, we're going to continue to track all these stories and much more. Let's continue to track the markets for you here as we count you down to the start of the 11 a.m. hour. The Dow Jones, the S&P 500, and the Nasdaq, they're all in the red, folks. The S&P 500 down a little more than 1%. Nasdaq Composite, tech-heavy Nasdaq down 1.3%. And the Dow Jones Industrial Average, you're seeing that lower by about 0.8%. Coming up in the next hour, Michelle Akupo is going to take you through all of the market action. And we head back to Davos for an interview with ServiceNow CFO. Stick around for that.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this afternoon. A port in a storm. The Haven trade catches a bid as mixed commentary from the Fed sends stocks into a tailspin. We take a look at the impact on the crypto space. Bitcoin coming off its best streak in 10 years. And it's a jungle out there. Tech layoffs hitting Amazon particularly hard as the planned cuts take effect. We'll speak with an analyst who slashed his price target on the stock. And thinking about buying a new home this year? Well, that's a good news, bad news situation. Mortgage rates are up, of course, but inventory is heading higher as well. So are there opportunities? The full breakdown this hour. Well, first, let's take a look at the major indices an hour and a half into the trading day. We see there the Dow off more than 230 points there, the S&P there off more than about 34 points, the tech-heavy Nasdaq there down more than 1% on the day. We know that weekly jobless claims and a more hawkish Fed really weighing on investors' minds right now. Let's also take a look at what we're seeing on the Treasury market side. We're seeing Treasuries on the move as investors really weighing that possibility of recession for 2023, putting pressure on growth stocks though. We see there the 5-year up just slightly there, about 1.33%, the 10-year up 0.8%, and the 30-year up 0.8% as well. All right, first let's check in on the crypto market. It's seeing a wave of red this morning, bringing an end to Bitcoin's winning streak. We have Yahoo Finance's Inez Ferrer here with the latest. Quite a streak to be breaking here.
Yeah, that's right, Rochelle. And we're watching Bitcoin right now that's underneath the $21,000 level. This is a 2-day chart, so you can see some of the price action over the last 2 days. So yesterday we had some news. The DOJ said it was going to make an announcement, and it announced that it is going after an exchange called Bitslado, accusing it of laundering some $700 million, also arresting its CEO. Now, the chatter on social media was that nobody really has heard of this small exchange called Bitslado, so there was some criticism over that. But we also got some news as well, a headline from Bloomberg recently saying that Genesis, the crypto lender, could file for bankruptcy as soon as this week. Now, Genesis has stopped the customer withdrawals as of November 16th, just another domino that's been falling really because of after the FTX debacle that happened, the downfall there. So just looking at where we're at with crypto-related stocks, this is an intraday chart for today. You can see some pressure on these stocks, but I'm going to pull up a 2-day chart since these headlines that we've been getting around the crypto world over the last couple of days, and you can see some of the pressure that we're watching with these crypto-related stocks. Coinbase down 9% over the last 2 days. MicroStrategy down more than 6%. Square, PayPal also lower as well. Rochelle?
So just a brief respite there and back into the crypto winter. Thank you, Inez. Right, well, as for the word on crypto in Davos, let's check in with Yahoo Finance's Julie Hyman and Brian Sozzi with more on what they're hearing on the crypto space at the World Economic Forum. Hey, guys.
Hi, Rochelle. Forget about crypto winter. I think it's about 13 degrees here in Davos right now. But even though we have sort of the specter of Sam Bankman-Fried and the collapse of FTX looming over the crypto industry, even those that are represented here in Davos, there is still discussion during the panels here in Davos about what's going on in the crypto industry. There's a lot of talk about blockchain. That's sort of where things have shifted. But we've been having some conversations about it. Among others, I talked to Jeremy Allaire, the CEO of Circle. Let's listen to what some people had to say.
USDC has actually grown since the FTX collapse, and it's actually, we've seen other digital dollar infrastructure stablecoins have significant declines while we've continued to sustain. And so, I think regulated, transparent, infrastructure like ours is well suited to this environment.
I think Bitcoin prices will come back, but it will come back in a way more organized way than expected. It will follow the interest rate. So when interest rate starts to fall, the Bitcoin price will come up, and everyone will ask, why did the Bitcoin price go up? It's because of falling interest rates.
FTX and SBF are not an exception. They are a rule. Literally 99% of crypto is a scam, criminal activity, total really bubble, Ponzi scheme is going bust.
I mean, Norio Urbini's in the minority here, let's be clear, because he also said he doesn't think there's anything to blockchain, right? And blockchain's actually a pretty popular underlying infrastructure for a lot of new technologies. we'll see if he's right.
It was just such a different, it was a vibe check, I think, for the crypto community, at least here at the World Economic Forum. Day one, I walked down the promenade here, and that's where you see a lot of companies set up, sell their wares, try to get business done, promote what they're doing. Not a lot of crypto companies here.
There was blockchain.
There was
and there is
blockchain, Circle, yes. But again, it was a different vibe here for crypto and even blockchain compared to just a couple years ago. And all that money was flowing into the space. Sure. But alongside all that money came a lot of hype, and all of that clearly has been blown up, and hence they're not really here in a big way.
Right. Rochelle, it was really interesting to talk to Michael Goniger of Chainalysis, because he did talk about sort of what happens now in the industry in a post-FTX world.
I mean, a lot of people wondering, it really comes down to use cases. When it comes to the tokens, people might be losing faith. But even with blockchain, we're seeing people really want to see some actual real-life use cases in everyday life. So some people, it's still a hard sell. Great stuff there, though. Brian Suzy and Julie Hyman there for us in Davos. Thanks, guys. All right, shifting now to the energy markets, investors increasingly questioning whether the run in energy equity outperformance can continue into 2023. Here to discuss is Ben Cook, Hennessy Energy Transition Fund Manager at Hennessy Funds. Good to see you, Ben. So as we've been seeing the last 2 years, we've seen some of these energy stocks rallying incredibly. I mean, if you look at Exxon, up more than 120% over the last 2 years. How much longer can this run continue?
Yeah, good morning, Rochelle. Thanks for having me. Look, we see continued outperformance by the traditional hydrocarbon energy sector into 2023, largely due to a continuation of the tailwinds we saw in 2022. We see commodity fundamentals continuing to improve. We see a valuation case that is attractive in our opinion. And we see, broadly across the sector, a return of capital to shareholders, which I think will maintain the interest level we've seen in energy equities into the coming year.
And Ben, I want to look at some of these oil and gas prices. I mean, we've seen that oil and gas related stocks are not moving as enthusiastically as we're seeing actual oil prices move. What are investors mulling right now?
Yeah, I think there's a couple things that investors have on their minds with regard to energy today. Obviously, the zero COVID lockdown policy in China, as it eases, it will continue to provide a tailwind to demand. The pace of that improvement is clearly on the minds of investors. We're no longer seeing the SPR withdrawals on the market, so that's the absence of additional incremental barrels, again, provides a bit of a tailwind to the commodity market. I think the continued tightening activity by monetary authorities on a global basis, that's clearly on the minds of investors. It's interesting when you think about the demand picture for 2023, we could very easily see, despite continued rate hikes and the potential for slowdown in economic activity here, we could see continued growth in oil demand on a global basis due to the reopening in China. Our base case is in 2023 is for oil to average between $80 and $100 a barrel. And in that environment, we see very good operating and financial results for many of the companies that we follow in our investable universe.
And Ben, as you talk about China's reopening, we're seeing the IEA predicting that China's reopening could send global oil demand to record highs of about 101.7 million barrels per day in 2023. Obviously, still a lot of uncertainty about the pace of this reopening. But when you also factor in Russia also wanting to supply to China and India as well, how does that shape your strategy here?
Yeah, there's clearly, just given the lack of transparency in the global oil trade, volumes of oil leaving Russia, making their way to China and India, there's definitely supply disruption. But it's interesting. Oil, very much like water in a river runs to the sea, oil will find its way to the market. And we anticipate that volumes from Russia will continue to make their way into the market. I think the key here is the lack of investment in Russia and the anticipated impact that will have on reinvestment into the industry. Over time, if Russia continues to be negatively impacted by price caps, embargoes, and they're receiving less revenue for that oil sale, well, then that's less money that's going to be reinvested back into their industry, which means their supplies will be challenged to grow. We think that's likely to happen over the next 12 to 18 months, and again, provide support to the global crude oil market.
So then for people looking for opportunities in this environment, which energy companies do you like at the moment?
Yeah, we like the U.S. upstream sector. We think, again, based on the improved commodity fundamental picture that we have for 2023, we think the valuation case for the upstream sector continues to screen very well. And also just, when you look at the return of capital, again, a very strong investment case can be made. We do like Exxon in the large cap integrated space. We like EOG Resources in the U.S. large cap E&P space. And we like Cheniere Energy. We think the U.S.'s largest LNG exporting company will continue to benefit from tightness in the global LNG market for the next several years. So those are three high-quality names that we feature in our energy transition portfolio, and we think 2023 stands to be a good year for those companies.
And Ben, you noted that equities are pricing in a more dire situation than is currently reflected in market fundamentals. What is it you think that they're missing here?
Well, I think the market is really not giving credit to these companies, given the amount of balance sheet improvement and share repurchases and dividends. Historically, these companies have ramped spending in a pro-cyclical manner, meaning they would increase spending as commodity prices would rise. What's different today is that the companies are returning cash to shareholders as opposed to reinvesting in the business and growing capacity. And that's been good news for investors. Cash returns on the integrated space and the E&P space in the U.S. yields are on the order of 9-10%. And balance sheets are extremely strong. So for investors that may be thinking that we're heading for a recession and a downturn in economic activity that historically has coincided with a collapse in commodities and a downturn in the equities, I think this time is different. These companies, their balance sheet strength, their ability to return cash to shareholders makes the investment proposition much more attractive. And I think that's not getting the credit it's due in the marketplace, and largely is driving the difference in valuation relative to historical norms.
Well, thank you. We will be tracking that. Ben Cook there, Hennessy Energy Transition Fund Manager at Hennessy Funds. Thank you for joining me this morning. All right, coming up, show me the money. Slumping ad revenue continues to hurt Twitter, so not a great time to have interest payments topping $300 million coming due. We look at Elon Musk's ongoing battle to steady the ship next. please pay immediately. Elon Musk's $44 billion Twitter deal was funded in part with bank-backed debt, and the due date for his first installment is reportedly due soon, this according to the Financial Times. Here with the details and more from Musk World is Yahoo Finance's Dan Howley. Dan, never a dull day for Elon Musk.
No, never a dull day at all. He basically financed or partially financed this deal with $12.5 billion in debt. And so he's going to have to start paying up on some of that. The interest payment that seems to be coming due is around $300 million. That's according to these reports. So he's going to have to figure out a way to ensure that Twitter can pay that. If he doesn't, then that could obviously lead to bankruptcy proceedings. But this is one of the first debt payments that he's going to have to make on those loans. And so this, comes at a time when Twitter is dealing with a drop in advertising revenue that seems to be almost unheard of. According to different reports, some of the drop is as much as 50%. That's according to the information, 40%, with 500 of the company's top advertisers stepping away. Now, part of the problem is that a number of advertisers left initially because they weren't sure of how Elon Musk was going to treat the company, whether or not he would allow unfettered speech. He did bring back some of the people that were banned on Twitter initially, notably Andrew Tate, the right-wing kind of personality. He was then obviously arrested after going toe-to-toe with Greta Thunberg. But then he also seemed to try to get advertisers or attempt to strong-arm advertisers into coming back by shaming them or threatening to shame them on Twitter. Obviously, there was also the debacle with Twitter Blue, where when it initially rolled out, there were people that were putting up fake accounts claiming to be from major advertisers like Eli Lilly, and then buying those blue check marks, and when in fact they actually weren't those. And that caused stock prices to drop for those companies that ended up being impersonated. So, it's just been this overall just awful experience seemingly for Twitter so far, and it doesn't seem like the news is getting better. All the while, Elon Musk tweeting about how the actual product on the server side of things is improving.
And you mentioned that blue check mark as part of Twitter's efforts to try and turn a profit. And we now have some clarity on Twitter Blue pricing for Android. Tell us more about that.
Yeah, so the pricing is going to be $11 a month if you sign up on Android. That's the same as if you sign up for iOS. You sign up on the web, you pay $8. Now, this is confusing. Obviously, if you're not following the space, you don't recognize why this is these prices vary. It's because Apple and Google both charge fees when things are sold through their app stores. That's that 15 to 30% fee that they both charge. So what Elon Musk is seemingly doing here is trying to recoup that by raising the price on iOS and Android to $11, while you can buy for $8 a month on the web. Now, if you want, you can get a savings. If you go to the web, you could pay $84 for a full year. But this kind of goes to the point of, Elon Musk at this point needing to generate revenue in some way. And while, app developers would generally say, look, we don't like the idea of iOS or Android having those fees in place, forcing us to charge more to users. This seems to be a larger issue for Twitter just because it's in this situation where it needs to pay back this debt.
Indeed. I still remember Elon Musk saying buying Twitter was not about the money. Definitely not the case, as we can see. Dan Howley there, thanks so much. All right, well, staying with tech, the cost-cutting continues at Amazon. The Amazon Smile charity donation program, the latest to get the axe. This in addition to continued layoffs and other money-saving measures. The Street hoping these efforts pan out in earnings. Here with more is Rohit Kulkarni, Managing Director at MKM Partners. Thank you for joining me, Rohit. So first I want to start with these layoffs that we saw. 18,000 job cuts in the US, Canada and Costa Rica, about 5% of their corporate employees. What is your take on these cost-cutting measures and whether it'll be enough to offset some of these losses?
It's a positive first step. I would put the cost-cutting measures that companies like Amazon are doing is a positive first step to essentially get the costs in line with the demand curve that they're seeing. Demand is obviously slowing down. We have seen 5 consecutive quarters of Amazon seeing softer revenues versus what Street was modeling. Q4 and Q1 could be the sixth quarter in a row. So which means this company needs to get their costs under control in line with what their demand is. And I think employee headcount is probably the last thing that a company wants to touch, particularly for a company of size and scale of Amazon with fulfillment centers, data centers, employees inside warehouses. So I think it's a good first step. Whether it helps with the overall margin profile, and that remains to be seen.
And Rohit, on that, I mean, you cut your 12-month price target to $125 from $145, pretty significant. What really prompted that? And do you see Amazon perhaps returning to better growth at some point?
The price target reduction was driven by downward revision of estimates. So we now see the company having slower growth in first half. And right now we think with macro and with other kind of organic product improvements the company is having, they could see accelerating growth in the second half. So that's kind of the first change we did. And secondly, we see the margin profile to be depressed in the first half with softer demand, and then we see slight margin improvement in the second half. So it's almost going to be like a tale of two cities of first half versus second half for Amazon. And near term, I think the stock is going to be under pressure given what is happening with the cloud computing segment. That drives the investor sentiment to a large degree. That's the growth engine, that's the profitability engine of the company, and that's the biggest negative surprise that the company gave back in October, November, where they talked about growth slowing down, and I think per our checks, the growth has stayed slow and has started to slow down even more. So yeah, price target due to a reduction in what we think the company could earn over the next 12 months, but also we like the stock here because we see the downside risk as fairly limited, maybe mid 80s, but the upside can go well beyond 125 if things go in their favor.
And we did see that slowdown in growth with AWS. It really did come as a surprise here. What do you think went wrong with that? Is it a case of too much competition or people really pulling back on spending?
In our opinion, per our checks, it's more about kind of the COVID pull forward that's slowly digesting through the cloud spend that's happening both at Amazon, Microsoft, as well as Google. In 21, a lot of companies signed significantly large contracts with these companies, committing spend up to 5, 7, 8 years ahead, seeing what they were seeing on the internet in 21. In 22, they started to see slight slowdown in usage while their cloud bills started to stay high because of the pricing that anniversaries through Amazon. So people are starting to shift down their price tiers and shift down the amount of usage they're doing on the cloud. So right now it's more of a macro and a more of a industry trend. We think it's less of something that's exclusively for AWS. We think AWS is still the market leader, has the market share above and beyond Microsoft and Google. So I think as the industry recovers, AWS stands to gain share, stands to accelerate revenues, but I think it's a matter of time.
And Amazon, of course, also expanding its offerings with its Buy with Prime that's going to become available to third-party sellers coming up February 1st. So as you look at the spectrum here, because I know you cover a lot of tech firms, including Meta, Google, Snap, as we come into earnings season here for them, who are your top picks at the moment? How are you positioning yourself?
From an earnings standpoint, we see very limited positive catalysts for the stock coming into 1Q outlook. We see 1Q as probably the trough from a fundamental standpoint for most of these companies. Having said that, there are companies like Amazon that have probably some of the negative upcoming catalysts already priced in. As I said, there may be limited downside risks. So we like Amazon heading into earnings. We also like Meta, although a lot of catalysts for Meta are based on to what extent does the company believe that they need to reduce their operating expenses for 23. That's going to be the turning point. If they reduce the spend by a little bit more than what Street is modeling, I think the stock holds here and continues to grind higher. So those are the two names that I would flag. The rest of the names are going to be more tactical opportunities around near-term earnings, which is very hard to have conviction on.
A lot of diversity in the tech space to keep an eye on there. Rohit Kulkarni there, Managing Director of MKM Partners. Thank you for joining me.
Thank you.
Right, well, Alec Baldwin to be charged with involuntary manslaughter for the fatal shooting of a cinematographer on a New Mexico movie set in 2021. 42-year-old Halnia Hutchins was killed when the Oscar winner's gun went off while rehearsing a scene. The film's armorer has also been charged with involuntary manslaughter. In October, Hutchins' husband reached a settlement in a wrongful death lawsuit against the producers of the movie. All right, coming up, tech is the word in Davos. The biggest players in the space showed up en masse in the Swiss Alps, but it comes amid brutal job cuts. We hear from cloud computing giant ServiceNow on where the industry goes next. Don't miss it. The tech layoff story dominated the end of 2022, and of course it's bleeding into this year, with Amazon's cuts beginning and Microsoft's announcement yesterday that it's slashing 10,000 jobs. Well, the presence of big tech certainly being felt in Davos, with the likes of Meta, IBM and Zoom all visible in the Swiss town's main promenade. Yahoo Finance's Julie Hyman and Brian Sozzi spoke with another leading tech name, cloud computing giant ServiceNow. The group CFO struck a cautiously optimistic note on the road ahead for the sector.
What we're seeing from a technology perspective is that the technology strategy continues to be the business strategy. And what that means is they're talking about IT spending at about triple the amount of GDP and software spending almost double that. And so I've been meeting with tons of customers while I've been here, and digital transformation remains top of mind for everyone. And what they're looking for is they're looking for platforms that are able to simplify the complexity, are easy to use, and are quick time to value. And luckily ServiceNow ticks all of those boxes. So really excited about what we're seeing in the market, although certainly elongated deal cycles and more scrutiny around deals in this in this economy continues to be commonplace.
Gina, I have long looked at the CFO, especially the past few years, as the Chief Transformation Officer. That position wears a lot of hats. As you look at your day-to-day, what's your biggest challenge you're up against?
Well, you're absolutely right. I think the role of the CFO over the last 3 years has really evolved to very much a strategic business partner to the entire business. And why that is because we have a bird's eye view across the enterprise. And so I spend as much time with my finance organization as I do with my CHRO, for example, because talent is so incredibly important as I think about growth for the mid and long term. I spend so much time with my CIO as well because the technology strategy is the business strategy. And so those cross-functional relationships are more important than ever. And so you're absolutely right. The role is definitely evolving and spending a lot more time with the business, with customers, and really understanding what are going to be the levers for growth in the short, mid, and long term.
ServiceNow has been very aggressive, or staying very aggressive on the hiring front. We're always hearing that from your CEO, Bill McDermott, on we're hiring. How do you balance that against what investors want right now, more of a focus on the bottom line?
Well, you're exactly right. Investor sentiment has definitely shifted from a growth at all costs to a balance of growth and profitability. But ServiceNow has been really disciplined in both for years now. And so it positions us really well. We have best-in-class margins as well as best-in-class growth. So while we are not in a position to have to do layoffs, we certainly have, slowed down hiring a bit during the back half of the year, which positions us well to not have to do any layoffs, but continuing to grow. We are absolutely hiring with a priority on sales and engineering talent, and you'll continue to see us do that because talent is what's going to really accelerate growth.
Is it easier to find talent right now? In other words, are you snapping up some of the folks who are maybe getting laid off from some of your competitors?
We absolutely are. The market right now is interesting for sure, and the ability to snap up some great talent is better today than certainly the last year. So we're taking advantage of that for sure.
Take us through by market. What would you say is your strongest market right now, and why do you think that's the case?
IT remains extremely strong. As you can imagine, resiliency, security, IT operations, having to do more with less. And again, the technology strategy being the business strategy, we're seeing IT workflows holding up extremely strong, but also employee workflows, employee engagement, more important than ever post-pandemic. So our employee workflows doing very well, customer workflows. Everyone is focused on the customer more now than ever. It's one of our largest addressable markets, and so we continue to see really good growth across the portfolio.
You said earlier in one of your answers that you're hearing sort of cautious optimism here on the economy. It's interesting because it sort of depends on who you talk to, right? Some people are saying, oh, yes, we're going into recession. But overall, it does seem to be a little bit less dire, maybe. What are you hearing on the ground? What's the vibe, for lack of a better word?
Yes, and interesting. I was talking to economists from Europe, from the U.S., as well as Asia, and interesting because very rarely do they agree, but the tone has been much less pessimistic than I anticipated. And certainly, while recession is likely in many economies, the thought about soft landing and not as deep. The fundamentals are much stronger. Banks are in stronger positions. Consumers have stronger savings than they did 10 years ago. So the fundamentals seem stronger such that if a recession does occur, the likelihood of a soft landing seems more credible today than what I've been hearing kind of 4 months ago.
ServiceNow CFO there on the road ahead for tech in Davos there with Brian Sozzi and our Julie Hyman. All right, coming up, a lot has changed in Cuba since then US President Barack Obama stepped off Air Force One in Havana and reset relations back in 2016. Our Rick Newman just got back from there and has a few things to get off his chest. That's next. Amid the historic wave of Cuban migrants entering the U.S., Yahoo Finance's Rick Newman took a trip to the country to learn a bit more about America's communist neighbor. He joins us now to discuss the most surprising findings from the trip. Good to have you back, Rick. So what stood out to you?
And those are some of my photographs I took just with my iPhone while I was there. Amazing contrast in Cuba. Some of the buildings are falling apart, and yet there's great art, there's great culture there, good food if you can go to restaurants that get imported products. A couple of things really surprised me on this trip, Rochelle. I've got a full story up on the website, but just to tick off a couple of those things. First, there actually is what you might call a burgeoning private sector in Cuba. I did not realize this, but the communist government there has changed the rules in recent years. So you are allowed to start a private business now. Tax rates are pretty high, about 50% all in, but you are allowed to keep profits once you pay your taxes and abide by other rules. There are some limits on this. You can only own one business. It can't employ more than 100 people. But on this trip, I was able to talk to some business owners, and they're pretty ambitious. And one of the things they tell you over and over is that the U.S. sanctions on Cuba, which have been in place for a long time and actually got tougher under the Trump administration, really make it difficult just to operate a business in any normal sense of the word. There are financial restrictions that make it very hard to import anything, from raw materials to finished products. People told me, for example, sometimes you can't even get paper to make paper bags that people can use at gift shops. A clothing business owner told me the best way to get plain T-shirts in Cuba so local designers can print them up is to actually buy them in bulk in the United States or some other foreign country and then put them in your luggage and bring them on the airplane on the trip back to Cuba. I mean, just amazing hurdles that these people have to go over. But there is a private sector forming there, and another recurring theme from government officials, private sector officials, people who work for state-owned businesses, they want to buy more American products. Everything from food to fuel to medical supplies. Sanctions make that very difficult, and I'm not sure that is likely to change anytime soon. But if we can ever get over the sanctions on Cuba, they seem to be a ready customer for a lot of American products.
So then, I mean, as we saw the reset with Barack Obama, then we saw Trump imposing the sanctions again. In terms of President Biden, then, any prospect of reopening the relationship between the United States and Cuba? It's
a really interesting question because Biden has actually said more than once that he wants to reverse the Trump policy on Cuba, and basically go back to what Obama did. Sometimes I mix them up and I call them O'Biden. Sorry about that. But he wants to go back more or less to what Obama did, which is open up and set the stage for more trade between the United States and Cuba. But he has actually done very little since he became president. And the politics on this are very thorny. There are some very passionate, mostly Cuban Americans in Florida, who are staunchly opposed to any reopening with Cuba. And that's because they or their families lost a lot when Fidel Castro took over the government in 1959. And they say no reopening to Cuba until that communist government changes its ways. On the other hand, a lot of people would like to business people in the United States would like to be able to sell more products to Cuba, but there's just not a real strong constituency pushing for that. So the Biden White House may want to open up with Cuba, but I think they just don't feel like there's anything to gain from doing that, and they might get punished by some voters in Florida if they were to open up. So could be more to come on this in Biden's second year when he might have a little more freedom to do stuff. We will see in coming months.
Certainly doesn't want to risk that voter backlash. Indeed, Rick Newman there. Thanks so much.
See ya.
All right, coming up, building the foundations. Is it ever too early to become financially literate? We speak with an expert on a mission to teach our youth the invaluable lesson of money management. We get personal with your finances next. The outlook for housing and prices might still be gloomy in 2023, but for those of us needing to buy a home this year, there are still some ways to prepare. Let's take a look at how to make the process more affordable and secure. Joining us now, Yahoo Finance contributor Vera Gibbons. A lot of people looking at these house prices and wondering, oh, what can I do at this point?
Right. You know, Rochelle, that's the top challenge for 2023 is affordability. So you've got prices still elevated. You've also got mortgage rates significantly higher than they were a year ago. We're at about 7% now, which is almost double what we were at the start of 2022. So that continues to be challenging. But the good news is that inventory is up a little bit. Fewer buyers are actually out there hunting, so you might have a little less competition. Not to say that you're going to get a deal necessarily or a bargain. It's still a pretty challenging market, but it's not going to be as crazy nutty as it has been over the past couple of years. It's going to be more balanced, according to the experts I've spoken to. They say that's what we can expect. Not the frenzied, crazy pace, nothing at all like last year or the previous year, but a more balanced market. So that's good news.
So what tips do you have for people in this environment? How can they sort of edge out some of the competition and get a home?
Well, first things first, of course, you've got to, get your financial house in order. That means, wiping away any outstanding debt, boosting your credit score so that you can get the best possible rate on mortgages. Particularly important now since mortgage rates are so high. The better your credit score, the better mortgage rate you're actually going to get. Then, of course, you want to shop around to get pre-approved for that mortgage. And you do want to shop around. Don't just go to one lender. But once you can figure out what you can comfortably afford month to month, shop around and see what kind of rate you can get that is going to meet your budget. Once you've got the finances squared away, then you can hit the ground running. But you don't actually have to run. That's the good thing about the market in 2023. You can actually take your time to some degree. You can look around, check out the neighborhoods, know what the crime situation is in the neighborhoods. Research the school district because, as you very well know, home values tend to hold up better in a decent school district. Also, check out the commute. What is your commute to work going to be like? Are you going to have to commute? You've actually got a little bit of time on your side. So look at the whole picture and then also factor in additional financial costs. I think a lot of people overlook things like homeowners insurance, for example, in a market where I am in Florida. Those premiums have skyrocketed because of the hurricanes. So that's something you want to factor in as well. If you're mortgaging your purchase, you do have to get homeowners. But as I say, in a market like Florida or even a market like California, because of the wildfires, those premiums are extremely expensive. So you want to factor that in, as well as costs like the HOA fees, property taxes. I think a lot of people, especially first-time buyers, jump in feet first thinking, oh, they've got the down payment and they can figure out the monthly payments. But that's really just the start of home ownership. And then finally, I would say, make sure you're willing to make a long-term commitment because the transaction costs of moving in and out every couple of years is just not worth it. So make sure you're able to commit to 3 to 5 years. Make sure your job is secure. And if your job isn't secure, make sure you've got some extra money in the bank parked away so that you don't run into a financial pickle. So there's a lot of different moving parts to buying in 2023. But again, the good news is that it's not going to be as crazy, competitive, bidding war type of situation that we've seen over the past couple of years.
So still complex, but at least not as competitive as we've seen over the past year. Great stuff. Vera Gibbons there, Yahoo Finance contributor. Thank you so much. All right, well, fintech startup Greenlight is on a mission to empower parents to teach their children money management. The company offers debit cards for children that allows parents to set flexible controls on their kids' money activity. Children invested over $13 million in 2022 using Greenlight and saved over $116 million. Joining us now is Greenlight CEO Tim Sheehan. Tim, thank you for joining me. So a lot of parents wondering, perhaps they don't have their own financial literacy in underhand. How should they be using this to really empower their children to have better money management?
Yeah, it's really a suite of tools. So, if you have very young children, it helps them learn, money doesn't grow on trees. You have to work for it. You have to earn it. So it has chores tracking and allowances built in there. It has savings goal tracking so the kids can learn to actually save for a specific goal and kind of learn how to do that. And then as the kids get older, there's a debit card that's included with kind of parental controls so the parents can kind help them learn how to make trade-off decisions and spend their money. But there's something about where, because it's the kids' money and because they have this ownership over, this is their debit card with their name on it, their behavior starts to change. They start to learn to make these trade-off decisions. It's almost kind of magical. It's amazing to see it happen. The kids can also learn how to invest. So they do the research into ETFs like VU or, into stocks like, Amazon or Apple or whatever it might be. And then they can propose the investment to their parent, and the parent can then, ask them some questions. Like I'll ask my son, so why do you think you should, invest in Visa? Where did you, or Nike, what made you think that would be a good investment? And you have that conversation, and that's where the learning happens. We include stuff like Morningstar premium content is included in there, so the kids are getting objective, good information to base their research on.
And Tim, you mentioned Apple, Amazon, VOO as well. Talk about the ways that they're putting their money to work on the investing side first, and then the savings side.
Yeah, it's really wonderful to see it. They, as really probably everybody watching this show knows, learning how to invest at an early age and actually getting started at an early age can have a massive impact on your life. And it definitely did for me. That was one thing I was lucky enough to learn at a young age, and it helped transform my life. I'm trying to do really what my parents did for me. I'm trying to help every parent do for their kids as well. Help the kids learn how to invest, help them learn to just make basic trade-off decisions between, do I want to buy this thing right in front of me, or should I save my money and buy the thing that I really want later? We actually created this financial literacy content into a game. So one thing it's kind of a shame is there's a lot of fantastic financial literacy content out there, but the kids just they're not interested in it. They don't actually, and even most adults, frankly, we're not interested in, reading a bunch of dense information and kind of learning it that way. So what we did is we took the K through 12 national standards for personal finance, and we hired our own experts and put them together with product designers and game designers and engineers. And we built this level up game that is just fantastic. Basically, the kids play a game, and in playing the game, they're learning all of the personal finance basics, but exceeding the national standards for K through 12 for personal finance. So basically, when a child finishes with level up, they will know everything that is covered under those K through 12 national standards.
I mean, it's incredible because you're also, as you mentioned, they're partnering with classrooms as well. But I do want to ask you, obviously, expanding and you have this macroeconomic background does come with some bad side effects. We know that you had to have some layoffs, more than 100 people there, about 21% of your workforce there. Talk about those layoffs and the decision that went into that.
Yeah, it's what you said. The macroeconomic environment. It's difficult, and it's affecting every business. And Greenlight's no exception. So we did what we needed to do in order to continue to serve our customers. We obviously are, our focus on our mission is absolutely the same, trying to help parents raise financially smart kids. But we're just trying to navigate this difficult environment along with really everybody, whether that's another business or consumers as well, facing high inflation and such. So yeah, we're just trying to stay focused on level up the game, on Greenlight for Classrooms, which we're making available for free to every teacher in the country and every student in the country. So still trying to do the right things, but have to also face the kind of harsh reality of the current macroeconomic environment.
Indeed. Well, we do appreciate you joining us. And the more financial literacy, the better. Tim Sheehan there, Greenlight CEO. Thank you for joining me this morning. All right, coming up, are you a regular Joe who likes their Joe regular? Or maybe you like a splash of oat and some sweet cream foam? Either way, you're one of the millions of Americans getting caffeinated every day. We take a closer look at how much we're consuming next. How many cups of coffee do you drink a day? Well, if your answer is more than one, you're not alone. In today's chart of the day, we're taking a look at American coffee consumption. A recent report by Statista shows that almost 80% of coffee drinkers have 2 or more cups while at home during the week, and nearly a quarter also drink coffee to go several times a week. Over 30% of respondents say they prefer good old drip coffee, 11% prefer cappuccinos, and 10% prefer iced. But one thing the majority agreed on is that coffee is pleasure to them. Now, I know that coffee is always flowing in this newsroom. Me, myself, I prefer, just a regular PG tips. A simple black tea seems to do the job. All right, well, before we go, let's do a final check of the markets. We're seeing that the major indices are still hovering around the lows of the day. The Dow there off by about 280 points there. The S&P off more than 1%, down 39 points. And the tech-heavy Nasdaq down 1.33% there, down about 130 points. Well, that will do it for now. I'm Rochelle Akufo, but I will be back at 11 a.m. Eastern. That's 8 a.m. on Western time. We'll see you then.